Welcome to February, where U.S. equity futures are on the rise. That's a change as the Dow lost ground 6 of the past 7 sessions. And Robinhood shrinking its list of restricted stocks, but GameStop is still there. Now retail interest sending silver prices surging, hitting their highest levels in 8 years. We're going to talk about the Reddit rebellion with the former TD Ameritrade CEO Joe Moglia, and with former Citigroup Vice Chairman Ray McGuire, who's running to be the next mayor of New York City. We'll talk to him about the future of New York. The final hour of Squawk Box begins right now.
Good morning and welcome back here to Squawk Box on CNBC. I'm Joe Kernan along with Becky Quick and Andrew Ross working on what is a snowy morning in the Northeast, expected to continue for another like 24 hours, I think. U.S. equity futures this morning are solid, starting off February on a bullish note, up 216 points now on the Dow. You can see the NASDAQ also participating, up more than 100 points. S&P trading higher as well. Take a quick look at Treasury yields. These are a pretty good barometer of what people think about prospects for stimulus or for the economy. Briefly, we were above 1, briefly went down. Looked like we would go below again. We're just slightly above that. And we're watching silver prices at one point hitting their highest level in about 8 years. It's up above 30 at one point. The move appears to be related to retail traders and social media chatter that the precious metal could be a new investment target. We're going to be talking markets, short squeezes, and so much more this hour with 3 big guests: former TD Ameritrade CEO Joe Moglia, Allianz's Mohamed El-Erian, and former Citigroup Vice Chairman Ray McGuire. And Robinhood, meanwhile, is slimming down the list of stocks that it's restricting. Those restrictions were first imposed last week as retail traders active on social media attempted a short squeeze. No, they attempted and it succeeded on stocks, including GameStop. This morning, GameStop trading is still limited. Robinhood customers will only be able to buy 1 share of that name and 5 option contracts. Other names still facing restrictions on the platform include AMC, Express, Koss, and BlackBerry. Meanwhile, a source is telling CNBC at least one hedge fund took a massive loss last month, thanks in part to its short bet on GameStop. Melvin Capital was down 53% in January as GameStop surged more than 1,600%. Becky.
Wow. Let's bring in our first big guest on these very topics, GameStop, the new power of retail traders and much more. Joining us for that is Joe Moglia. He, of course, is the former chairman and CEO of TD Ameritrade and the former head coach of the football team at Coastal Carolina University. And Joe, it's great to see you this morning. Thanks for being here with us.
Hi, Becky. I'm delighted to be on. Thanks for having me.
So I've been waiting to hear what you think about this. As somebody who knows this industry so well, knows the retail trader so well, what are your thoughts watching this play out?
Well, I think there's a lot of drama, there's a lot of emotion, and a lot of things going on. And I think what you really need to do is you have to put everything in context and you sort of have to frame it. So if I may, the focus should be right now, at least on the individual investor. So you've got 3 different types of investors. You got the long-term investor. Charles Schwab is focused on a long-term investor, very interested in a disciplined long-term strategy. Then you've got the active trader. Now, Ameritrade was focused on the active trader. You want to make sure they have risk management tools and they have really good education. Then you've got the day trader. That's kind of what Robinhood is focused on. Now, what's taken place now is in the day trading world. And I think, frankly, they've done an incredible job of being able to pull the retail community, the day trading community together to be able to get this done. Now, when you look at what took place, a lot of people say, well, there's a lot of speculation here. I can appreciate the speculation of day trading. I also can appreciate that when you day trade and the market is doing well, you increase the probability you're going to do better. Market is not doing well, the opposite could take place. But what happened here specifically is the people actually really did their homework on this. Now, they didn't do fundamental analysis, but they did incredible technical analysis. And when they figured out which companies, GameStop, were really significantly short, 140%, they were able to put a plan together to rally the community to be able to take advantage of that. So in effect, when they started to buy, remember there's a huge short, so they start to buy. By buying, they force the market up. You've got leverage involved. That's going to force the market up more. You got options involved. That's more leverage. We're going to force the market up more. Now, the clearinghouse is responsible to make sure that the trades get settled. When you do a trade, it settles in 2 days. So as the volatility goes up in the stock, the clearinghouse comes in and starts to increase their deposit requirements, kind of like margin requirements for an individual. And as it goes up, and as it goes up, and as it goes up, it gets to the point where at some point, in this case, Robinhood had to stop trading. They were forced to do that. I recognize that a lot of people think that they did that with the idea that, oh my God, they're trying to take advantage. You know, they want to protect the institutional investor. They had to do what they did. It was a requirement on the part of the clearinghouse. If they had not done that, they would have had to stop trading altogether. So that was something they had to do at that time. But that's at least the way I look at it. Look at a long-term investor perspective, then you got an active trader, then you have a day trader. This is the day trading world.
It sounds like you've got certainly some respect for the active day traders who were able to chase out the shorts in this. But when you look at there was a whole lot of disruption, angry people on every side of this trade, including the retail investors who were told they couldn't buy additional stocks and still can't on some of these platforms. What, if anything, needs to be fixed, Joe?
Well, I think with regard to that, I understand. I grew up on the institutional side of the business when I was in Merrill Lynch. But when I went to Ameritrade, I mean, for the last 2 decades, my entire concern has been the individual investor. Whether it's a long-term investor, would have to be somebody that's day trading. So I understand how they feel, but I think they understand that in a way that I think what is needed here is a little better communication with the traders, so they have a better understanding in terms of what took place. So when Robinhood stopped trading, they didn't do that to protect the institutional investor. They did that because they were required to on the part of the clearinghouses. If they didn't do that, they would have had to stop trading altogether. Now, I think if the individual trader understands how the system works, they would feel a little bit better about it. So you look at the front end. It's easy today because of great technology to buy or sell a stock. But behind the scenes, Becky, you've got incredible technology, you've got regulatory requirements, and that becomes pretty complex. And it's the job of the clearinghouse to make sure that when the trade settles, it settles and everything takes place. The money is exchanged, the securities exchange, et cetera. That's why they get involved with it. It's the regulatory agencies doing that. And long term, in effect, they're doing that because they want to protect the individual investor.
But Joe, let me ask you this. There are traders who are very angry that they couldn't trade these things. Is this a problem that is indicative of the Robinhood trading model? Is this indicative of free trading? Would some of these other platforms, if they wanted to keep trading, would you tell them go to Schwab, go to another platform because they have deeper pockets? What's the solution to these guys who are mad that they can't trade right now?
Well, no. Well, there is an advantage. I mean, frankly, there is an advantage. Let's say for Schwab, they've got greater technology. They've been in the clearing business, self-clearing business for a long, long time. They've got an incredible balance sheet. They've got $6.5 trillion in assets. Those are all significant advantages. So when you need to put up more margin requirement, a firm that's got a better balance sheet, greater revenue stream, has the ability to do that a little easier than a firm that doesn't quite have those resources. But at the end of the day, the reason why Robinhood had to stop trading was because they needed to be able to deliver on the deposit requirements, and that was and the requirements on the part of the DTCC were going through the moon. So Robinhood had to slow down. So with regard to what's going on, number one, I think if the individual trader recognizes what's going on behind the scenes, they have a little bit better understanding of this. The bottom line on this, the reason why people are upset is because their trade worked. If the trade didn't work and they didn't make as much money, I mean, they blew the cover off the ball. They did beat the institutional investor. There were institutional investors that had pain here. And the trade was so successful, it had to stop trading, at least in those stocks where there were issues.
So,
I'm answering
Joe,
your question, Becky, because I want to do that.
I think you did, but I'll follow up on it because I think it goes to this question, though, of business model. I think some people look at the business model of Robinhood, effectively leveraging the basically the trade. They're getting paid by Citadel in this case. That some people think that is a problem unto itself, and then there's this other problem, which appears to be just straight capital. You just need a massive capital cushion to be able to deal with trading, especially in this social media world where people can come as mobs and make these trades.
Yeah.
Are they connected? Are those business model issues connected? Meaning the free trading on one side, the capital on the other, or are we simply really just talking about a startup company that just simply doesn't have the capital cushion that it needs? In which case, the bigger question is, should they remain independent?
Right. Okay. So number one, they are connected. So you mentioned Citadel, and Citadel's paying for, in effect, order flow. That's payment for order flow. We're happy to talk about that separately if you want to. But with regard to the business model, the free trade concept works. It was 25 years ago Chuck Schwab said one day we're going to have no commissions. And in effect, commissions have done nothing but go down over the last 25 to 30 years on Wall Street. So free trading is an incredible opportunity for any individual investor that wants to be able to buy or sell stock or in effect be involved with the market. That's a plus. That's a plus. Now, when you have an opportunity that really starts to go, I mean, as incredible as this particular trade was, there are regulatory requirements associated with that. In order to handle the regulatory requirements, you are much better off in terms of, so free trade is nice, it's good, but it's not enough by itself. You've got to have another revenue stream. You've got to have a strong balance sheet. It's great to have assets under management. All those things matter. The more separate revenue stream, the greater your balance sheet, the more your assets under management, the greater the brokerage firm is going to be able to handle increased margin requirements. Robinhood is still in its early stages, and it doesn't quite have the resources that so many of the other large brokerage firms happen to have across the board. So with regard to Robinhood, that's the reason why the other day when they stopped trading, they needed to go out and raise money. They went to their line of credit. They also had investors step up to be able to help them out. Now, I think it was a positive sign that investors stepped up to help them out because they believe in the company. But at the end of the day, the fact that Robinhood doesn't quite have enough capital to be able to take care of this could be an issue. Now, they're not public with their information, so I don't know what the balance sheet looks like. I don't know if they have any other revenue streams. I don't know that.
Right.
But they're going to need more capital if this trade continues throughout the span of the week. But I'm aware of what they're doing today. So they're only allowing you to buy one share of stock of 5 options. So that's meant to help protect them as well.
Let me ask you this, though. In many ways, this was, at least it started as a protest vote by some investors. And a protest, I think, about hedge funds, the idea of manipulating the system, gaming the system. And one of the things that some of these people think and believe is that high-frequency trading has gamified the system to the benefit of hedge funds and not to the benefit of the masses. Do you agree with that, given that some of that high-frequency trading, if you will, is what's paying for some of these trades?
I think some of the I agree with that, Andrew, to a point. You know, I think at the end of the day, when you look at what happened here, though, it was the individual investor that was successful here. It wasn't the high-frequency trading. It was about millions of individual investors coming together with a well-thought-out strategy that had some leadership and incredible execution on that strategy. Now, there are, from the very, very, very beginning, so when I first showed up at Ameritrade, our entire commitment was, our entire mission at the time was we wanted to bring financial literacy to every family in this country. Again, the Schwabs of the world, even the E-Trades, everybody's got, not Schwab, Ameritrade, E-Trade, even Robinhood has the best interest of the individual at heart. All the business we do at Ameritrade or Schwab is with individuals or financial consultants that are working with individuals. So at the end of the day, the tools and the ability that the individual has today, far greater than they had 5 years ago, and that was far greater than what they had 5 years prior to that. So if 2020 was the year in our country where we had a lot of upheaval, and everybody's looking at racial, political, sexual equality, maybe 2021 is about individual investor equality. And do they have the tools and the skills to be able to execute these trades? They do have the tools. They can be taught the skills, but they need better education so they understand what the downside is and they understand what their risk is. They need to be able to have that. So the leaders in that world, I know in the brokerage world, that's a critical component in terms of what we try to deliver. But for guys like Portnoy and for guys like Reddit, for Reddit, you also have to take some responsibility to make sure people understand what's going on behind the scenes, and the individual investor understands the complexity, so they're better educated when the market turns against them, which at some point can happen.
Joe, it's pretty unusual for a stock to even double in value over the course of a couple of weeks, but to see some of these stocks go up more than 20 times in value over that time, how do you think this ends?
Well, well, I think it's a hell of a trade. I think you back up a little bit too, Becky, in terms of, go back to what we said a little while ago. People are being a little bit critical because they're talking about fundamental analysis. Fundamental analysis is a great thing, but normally it deals with the long-term perspective of a particular company. Therefore, the stock is it rich, cheap, et cetera. There's also technical analysis. You've got people on your show talk about the technicals, and they talk. You've got momentum. You've got different things going on. So you've got the leaders of this movement really put in incredible time to figure this out. So you have GameStop that had a short of 140%. Go back to 2008, the financial crisis, for a minute, and I recognize it's large institutions. But the reason why the financial world blew up was because incredible leverage. The short at 140% plus options plus margin is incredible leverage. And the short got squeezed in this case like I think no short has ever been squeezed in history. Now, what's the benefit of this for the institutional investors? I think it's great education for them. They've been able to do this, and do this for the most part successfully, for a long for decades. And now I think they recognize there is a way that they could get hurt that they have not thought about before. And I think before they put on significant shorts in a particular name, the institutional investor, I don't care how smart they are, no matter how successful they've been, they're going to have to think through this before they put on the short.
Hey, Joe, before we let you go, you know how many people had to learn how to say Chanticleer after you went?
First of all, Chanticleer, number one, you didn't learn it because the A's like Chanticleer, Joe.
Chanticleer. And do you take, was this you this year, the almost undefeated? Was this because of you? Did you lay the groundwork?
It was because of Jamie Chadwell as the current head coach. He won every Coach of the Year award there is to win in our country. He's got a great staff. He's got a great team. Now, I did recruit a good portion of that team, and I did coach a good portion of that team. That's what I mean. And I think we did do a good job of laying a foundation. But Jamie and his staff and the players in 2020 deserve all the credit for the incredible season Coastal Carolina had this year. I'm glad you brought it up, and I'm glad I was able to correct you on the pronunciation of Chanticleer.
That's what I said. See, that's what I said. So many people are just learning. I mean, I watched with my eyes wide open. That's Moglia's. It's amazing, amazing. Congratulations, and people loved watching them. They're very exciting, very exciting. A lot of scoring. It's great.
And again, you got to give that credit to the players and the staff and Jamie Chadwell. I couldn't be prouder of it.
Moglia's team. All right. Thanks.
Yeah. Thanks, Joe. We really appreciate your time today. Obviously, this is an evolving story. We'd love to have you back soon to talk more about it, but it's great to see you today.
Happy to come back. Hope I was helpful, Becky. Thank you. Take care, everybody.
You too.
Okay.
See ya.
Great conversation. When we come back, a lot more. We're going to have a couple of big interviews. GameStop. We're going to talk the markets and more. Allianz advisor Mohamed El-Erian And then we're going to talk to former Citigroup Vice Chairman Ray McGuire, who is running for mayor of New York City. And we're going to talk about the future of New York City. But first, a few of this morning's biggest movers to show you. Let's tell you about some of those headlines. President Biden slated to meet with 10 Republican senators today on COVID-19 relief. For what was described as a full exchange of views, the GOP group is proposing a $600 billion package, much less than Biden's $1.9 trillion plan. And Exxon and Chevron are said to have discussed a merger late last year as the pandemic took hold. Those talks were first reported by the Wall Street Journal, and although they're not happening currently, sources telling the Journal they could resume in the future. We'll keep an eye on that. And then Elon Musk saying he supports Bitcoin. The Tesla CEO made the comment late last night in a discussion on the app Clubhouse. He admitted he's been late to the party and said clearly he should have bought some of the cryptocurrency years ago. Unclear, and I got to look into this to see whether he's actually bought himself. Squawk Box returns right after this.
The countdown to the open of the US markets is sponsored by IG.
Helping you navigate the new normal. Squawk Box on CNBC.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The brave ones, like Mykowski. CNBC.
Still to come this morning, Allianz advisor Mohamed El-Erian weighs in on week 2 of the GameStop drama on Wall Street, including how he thinks it may end. As we head to a break, check out shares of Tesla. Piper Sandler more than doubling its price target on the electric vehicle maker to a street high $1,200 a share from just $515 before. Piper says Tesla could have new opportunities for decades. That stock's already at $816. Stay tuned. We'll be right back.
I want people to feel like they just learned something. I want them to feel like they understand something about their lives better than they did an hour earlier. We will sort through what's true and what isn't, and we'll give it to you straight, in context and with perspective. We will not waste your time, and we'll earn your trust. them to feel like that was an hour well spent.
The volatility in the shares of GameStop has crossed over from a business story to a cultural reference point. Here are Kate McKinnon and Pete Davidson this past weekend on Saturday Night Live.
I put all my money in GameStop and I can't lose.
So normally a stock price reflects a company's value, right?
Okay.
And 2 weeks ago, GameStop was valued at $17 a share, and then it went to $413 a share. Would you say that reflects the kind of business GameStop stores have been doing in the past 2 weeks?
We sell games?
Right, but are you good at it?
Not really. People download all their games now, so we're kind of like, I don't know, what do you call it?
A dying business?
Yeah, that's it.
Retail traders are now apparently turning their attention to silver, the precious metal, shooting up this morning, notching its highest level in about 8 years. Joining us now to talk about this in the broader market of all this retail activity is Allianz and Gramercy advisor Mohamed El-Erian. He's also the president of Queen's College, Cambridge. Mohamed, last week we had a couple of days, volatile days, where we lost 600 plus points. We had a rebound in between. We have a rebound today. Are you troubled by the speculation that this is a symptom of, perhaps, or is it the actual what's actually happening that troubles you about the underpinnings of the market?
So I'm fascinated by the new technicals, Joe, and thank you for having me. And that is that retail investors can have such an influence. You mentioned silver today. Silver is moving on the notion, and I want to stress it's the notion because it's being opposed by certain retail investors on Reddit, is moving on the notion that that's going to be the next target. But it's a very different target. But the fact that you can move silver such a large market is a indication to everybody that they have to take this new technicals seriously.
All right. So what are you saying exactly? Spell it out for me. So if you're on Reddit and you get enough people interested, you can cause them to bid up the price of silver. Is this going to theoretically end at some point? Will GameStop? And when the music stops and there's no chairs left for people to sit, are you expecting that stock to return to where it was, for example? And how's that going to look? And what does that say?
Okay, so two issues. The fact that you can get people to look at silver, and in the process they look less at GameStop. And because of that, there's less worry that the hedge funds who are short GameStop are going to sell, means you can impact lots of markets. So don't underestimate in the short term the influence. As to what will happen, look, there's a major battle going on between three actors, not two, three. The hedge funds that are short GameStop, the retail investors that are long, and the people in the middle. And the question as to where it goes next is who's got the weakest hand? Who's going to fold first? Who's not going to be able to stay in that trade? Now, historically, that has been the retail investor, historically. But the retail investors are more organized right now. So if they can stay organized, and that's why the silver issue is a really interesting wrinkle, if they can stay organized, they can actually force the hedge funds to cover more. But today, you get a notion that maybe they cannot stay organized. So we're going to see. The one thing that is systemically worrisome is if the intermediary folds. That is a completely different issue than if the two sides of the trade fold.
But you don't just ascribe what we're seeing with these shorted stocks into the same area as the hot IPOs, the SPACs, the Fed-induced irrational exuberance, if you will. Is it all part of the same thing? And are we in the late innings of this cycle?
It is certainly part of the same thing. When you take the cost of leverage to zero, and when you make liquidity abundant and predictable, which is what central banks have done, you encourage people to take on a lot of risk. You encourage people to take on a lot of leverage. You encourage people to take on a lot of debt. And we've seen all three happen. And this is yet another illustration of that phenomenon. So yeah, it is part of the whole thing. Are we in the late innings? I remember I've always told you one of four things is going to determine that. Central banks doing a U-turn on policy, they're not going to do that. Massive bankruptcies, unlikely in the short term. Market accident, perhaps. We came close to a market accident last week. Inflation fears. So keep the eye on the last two things. That is what tells you whether we're in the late innings or not. Otherwise, this can continue for a while. But we got close to a market accident last week.
Mohamed, let's, just for argument's sake, say someday that the shorts are all gone in GameStop. Where would you expect the stock would be at that point? Who would be the main owners of that stock? And what finally happens at that point? Is it like Wile E. Coyote or the Roadrunner? He looks down and, when he's out, and has gone all off the edge of the cliff and looks down, there's nothing beneath him? Or does it stay there? I don't know how it ends.
So technical short-term, fundamental long-term. So if your scenario plays out, whereas the shorts are forced to cover, they scramble, the price will go higher. However, that price is completely disconnected from the fundamentals. So the inclination of the longs to get out at that point is going to be very high. And that is a small volumes in terms of what can be sustained. So what you would get is the thing shoots up as shorts cover, and then it comes back down quickly as longs realize that they've succeeded. The hypothesis has played out. The strategy has succeeded. Now get out. So, yeah, it will end up lower than here. But if the hedge funds are forced to cover, it's going to go a lot higher first.
All right, Mohamed. I don't know what a lot. It's pretty high already. We'll see. Think about it. 500, 600, who knows? Anyway, thank you. We'll see you around, Mohamed. We'll see you again soon. Thanks.
Thank you.
Okay. Thanks, Joe. Coming up, when we return, Ray McGuire planning to revitalize small business in the Big Apple. The former Citigroup vice chairman and current candidate for New York City mayor is going to join us exclusively in a conversation right here on Squawk Box in just a moment.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcasts or your favorite podcasting app and subscribe to the Halftime Pod today.
This story went from a dilapidated, rundown duplex all the way to the White House.
Mr. Prosecutor.
American Greed on CNBC.
To come this morning, a Squawk Box exclusive with New York mayoral candidate Ray McGuire. We will ask him about his plans for what he's calling the biggest economic comeback in New York City history. Stay tuned. You're watching Squawk Box, and this is CNBC.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Welcome back to Squawk Box this morning. New York City was the original COVID-19 epicenter in the U.S., and about a year after it first hit, it's still taking a heavy toll on public health as well as business. A July report from the Partnership for New York City estimates as many as a third of the city's small businesses may never reopen. Joining us right now is an exclusive interview to talk about bringing the city back, New York City's economy, and what it all means. Former Citigroup Vice Chairman and now Democratic candidate for Mayor Ray McGuire. Ray, it's great to see you this morning. So many questions about the future of the city, so much concern within the business community, within citizens of the city about how you bring back this city. And I know you have put together an economic plan that I hope you'll share with us.
Good morning, Squawk Box. Started from the bottom, now we're here. Next version. From the streets to the suites.
Here we are.
Great to see you all. Hollywood couldn't make this up.
It's great to... Go ahead, Ray.
No, it's great to be with you all. Thank you. What can I tell you this morning?
It's great to be with you, Ray. Well, help us with this. I think everybody's trying to understand right now how you or anybody is going to make sure that this city thrives in the future, given some of the numbers we've seen. Frankly, given the tax base that appears to be continually eroding, we're seeing business people leaving the city in droves, being more mobile than ever. You're hearing about people relocating to Florida and other places. What do you do about this?
You know, it is what we explained before when I was fortunate to be here, honored to be here before, was George Floyd and COVID have revealed the inequities that we have known existed for quite some time, the inequities quite some time, systemic inequities in education, in the economy, in healthcare, and in the criminal justice system. What we need today is leadership that can move us forward in what I describe as leading the greatest, most inclusive economic comeback in the history of New York City. And what does that include? It includes the generation of 500,000 jobs, half of which will go to, as you've just outlined, small businesses, of which there 1 out of 3 is likely to be shut down forever. So we need to make sure that we inject into the small businesses. It's called Go Big, Go Small, Go Forward. The first part of Go Big is actually going small to focus on what is probably the most essential part of New York in our experiences, which is the small businesses. And what we've outlined is a jobs accelerator where we take 50,000 jobs and we underwrite, we subsidize half of the payroll for a year. That's number one. Number two, we want to have small businesses keep 100% of their sales tax receipts for a year so they can reinvest in the businesses. Number three, we want to have city permits and liens deferred. And let's come up with a way so that we can structure that, because what happens is that during these times, to the extent there are fines that get levied, there's no way that people can pay for this. We also want to make certain that for the small businesses that we negotiate some kind of relief. You know, I was just a couple of weeks ago in Brooklyn with Suites Brooklyn, and we gathered a group of small business owners. And what they outlined was the fact that they still have to pay utility bills at 100 cents on the dollar, but yet they're making 10 cents on the dollar. So we need to be able to negotiate some kind of relief for those small businesses, either rent relief or both rent relief and utility relief. And then we need to make sure that we have what I call the comeback bank. And that is to put money into the CDFIs, the local banks, so they can make investments into the small businesses in the form of grants, low interest loans and equity, and also mentorship. And that's the go small part. And the other part to this, when I get to go big, it is infrastructure. We need to invest in infrastructure. And as you know, the federal government has outlined a plan to invest in infrastructure. And my plan for infrastructure is to make sure that we fix basic infrastructure. And that includes fractured bridges and sewage mains. Make sure that that basic infrastructure is working. And it also includes what we do with the environmental crisis that we're facing. You got Coney Island. Sorry.
I was just going to say, Ray, all of this sounds great, but costs a lot of money. And the question is, do you raise taxes? Who do you raise taxes on at a time when we keep hearing stories about some of the wealthiest New Yorkers fleeing? And this is an issue not just in New York City, but it's actually an issue in many cities and states across the country, especially that have been hit with the SALT tax, where taxes effectively gone up on everybody. What do you do to tell them to stay and pay more if that's the case?
Well, Andrew, what we know about New York is that New Yorkers like me, I love New York. People love New York. What New Yorkers need is leadership. They need leadership and they need experienced leadership. People don't want to leave New York. They just don't have confidence. New Yorkers need leadership in which they can believe, that has a proven track record, who can get things done, who can also bridge the divide. Andrew, we need to bridge the divide. And so if they look at my track record and look at what I've been able to manage, remember, I managed through the crisis. I managed at the bottom of the last financial crisis that we had. I managed and built a team. I saw the stock go from $55 to 99 cents, and we had to invest. And so people love this city. What they're looking for is leadership. What they're looking for is management. They're looking for somebody who can bridge that divide, which is now so large. The ability to go from the streets to the suites and lead, and someone in whom they can believe. New Yorkers don't want to leave. This is the greatest city that exists. Somebody who wants to grow, who is pro-growth, somebody who wants to make certain that the cultural experiences that we have here are as vibrant as they are anywhere. Invest in the arts and culture. Invest in arts education. People want to be here. The aspirations around the world are still to be in New York City. You make it here, then you have been vetted by the most difficult competition that exists anywhere. So people love New York. It's just that we don't have a leadership that people in which people can have confidence. So I am quite confident that when I get into the mayoralship, that I'm going to be able to reach out to the leaders in the city, in Cambria Heights, in Queens, in Harlem, in Brooklyn, in Staten Island, in Manhattan, to make sure that those leaders come together. We need to bridge that divide and give people the opportunity that I had and that many of our children need to have. This is about the children. This is about how we grow our way out of this. And when it comes to the budget, we know how to manage budgets. This is what we've had to do. So you cannot tax your way out of this. Yes, those who have the resources like me and others will have to pay more, but you need to make sure we got the quality of life. And we can't be more efficient. We can be more efficient, but we can't cut our way out of this. We have to grow our way out of this. Right. So it's going to be a combination of growth.
What do you do? What do you do about the relationship between the public and the police? This is something that the business community often talks about as well, because the business community is often calling for law and order and more safety. And yet there is also a demonstrable conundrum between the relationship that the police and the public in New York City do have.
Listen, this is obviously very personal to me. It could happen to me, 6'4" black man. When on the day that we shot our launch video 2 blocks from my house, black driver and me got pulled over. So what do we need to do? We need to have what I call RAP, R-A-P, respect, accountability, and proportionality between the police and the community. Police and the community need to respect each other. Today, that trust has been breached. Why is that? Because those who are the serial abusers have not been held accountable. We've paid $200 million a year to settle cases from serial abusers. We need to address that visibly. And proportionality. We need to be able to have proportionate responses. It has been said, Andrew, that if the only thing that you have is a hammer, everything looks like a nail. In the black and brown communities, it's a sledgehammer. And so we need to make certain that we restore the confidence, we restore the trust. And how do we do that? We make certain that we invest in the mental health care professionals. 4 out of 10 calls that go to 9/11 have to do with mental health issues. We need to invest in the community organizations that can help intervene. We need to invest in the violence and the violence interrupters, like Life Camp in Queens with Erica Ford. We need to invest here. And so I want better policing. I want to reallocate the police budget, to get into those services so that we can prevent the crime.
Ray, before I let you go, just curious, since we've been talking about GameStop all morning, it's a unique issue because it has to do with the reputation in part of Wall Street, and you have political leaders from AOC on one side, Ted Cruz actually coming together behind this. Do you have a take on what's happening here?
You know, I think we need to be mindful about how we regulate this industry and whether or not we've gone too far so that the casino-like atmosphere, the casino-like environment is one that prevails. So we need to come in and make sure that we manage this much better, because the downside is that somebody is going to suffer pretty mightily in this. So we need to be very careful about how we manage instances like this and programs like this. So we need to be very thoughtful about that.
Okay. Ray McGuire, it's great to see you. We hope to continue these conversations throughout the election, and look forward to talking to you again very, very soon. Thanks, Ray.
Thank you for having me, Squawk Box. Appreciate you.
It's always good to see you. Thanks. Joe?
Excellent. Great. Thanks, Andrew. Let's get over to Jim Cramer. I know you were listening to Ray McGuire there, Jim, and sometimes what goes up sometimes comes down. Are you concerned for some of the, and welcome back, some of the action we saw last week? Or if you don't want to delve into that, you can talk about, there were some big earnings numbers that I know you were probably poring over in your spare time last week well.
Sure, I had Thermo Fisher one tonight. Mark Casper delivered. I have Ms. Marks delivered terrifically on Otis. Ray, just full disclosure, old friend of mine from law school, known him for years, talk with him behind the scenes, so I don't want to do anything people think is untoward here. We're just old, what am I doing? We're 30-year-old friends. I do think, Joe, that it's important to put this all in perspective. I think this is regulatory risk, not systemic risk. So I'm going to put it in the confines of what I regard as being what happened with the S&P during, not during the February decline, but much more with what happened in the VIX decline in January of 2018, in the flash crash of 2010, and then I would think Monday the 24th in August of 2015 when we had a China problem. So it's really those. So people don't feel like, well, wait a second, it's the end of the world. That's obviously not true. The actual number of companies that are involved in the squeeze and the size, the largest is 22 billion. Then before you get to even anything below 7 billion, you only have 7. So we have to keep that in perspective. I think the most important thing, Joe, is for people to recognize that the quarters were really good last week. And let's not forget that. It's the forest through the trees. There's some opportunities here.
Yeah. We didn't. I wish we had more time to do all the normal stuff, but it was, you got to admit, Jim, I know you were watching it. We were transfixed watching. Sure. I would never have believed that we would talk. We did talk about GameStop on this show a couple years ago, off and on, because we thought, is it similar to Blockbuster? Because, it just, if you're going to do everything online, and it looked like it was hit, and for that to be the poster child for going up 2,000%, it would have been the last. Do you see any similarities? But you remember iOmega? I know you do. You remember Press Tech? You remember Taser? Sure. Do you remember the company that had on airplanes? You'd open it up, and long before the internet, you'd be able to buy things. Sky Mall or something like that. That went up 100 times. Is this fundamentally different from all those things, Jim?
Well, we have to be careful because Taser became Exxon, AX, not the one that we're talking about, but AXN, and that turned out to be Rick Smith did a really terrific job, and that stock went up as more than GameStop when you look at it in terms of the ultimate, if you use it for a single digit. The thing I would emphasize is that GameStop's real. You and I were talking about when the Lake Paul range was on, because he's good friends of Ken Langone. But they got hit in a 2017-2018 transfer where they predicted a very big number for Christmas, and they ended up falling dramatically. And why? That was because the beginning of when Take-Two, EA, and Activision Blizzard switched to direct-to-consumer. Look, could Ryan Cohen have a plan? Absolutely. He might be able to take the money and be able to invest in e-gaming. He might be able to buy a Zynga. There's certainly a reason to think that he could get GameStop back to the glory days of 50-60. But, boy, that's still far away from where it is. Now, as soon as you say that it's not where it is, then you're courting the people who really want the stock to go higher. And I don't want to hurt them. But what I do want to say is that even during the glory days, it was hard to get to 50-60. They did a gigantic buyback, and they used a lot of debt. And they need to pay down that debt before they even get started, Joe. And, again, no one wants to hear that. And the company has been very mum. But when you look at the possibilities for what Ryan wants to do, it's still very hard to get more than an 8-bagger. So, I mean, to me, you've won. So why are you trying to staying at the plate? You've won, you won. I mean, this is the 5th quarter, if you want to analogize to the Super Bowl. You won. So why give back the win? And so that's what I'm more concerned about.
That's a good analysis, Jim. Excellent. Thank you.
Thank
and
you.
then we'll hear more in just a couple of minutes from you. More on the morning's big silver trade when Squawk Box comes right back.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Welcome back to Squawk Box. Let's take a look at some of the silver trading that's happening in the pre-market right now. Those COMEX silver futures just a hair below $30 an ounce right now, up 10%. As you can see here, a bit of a breakout from the recent trend that we've seen. So we'll watch whether or not that has more legs. The other thing to watch right now is what's happening with silver ETFs as well. There's been a huge demand for that in the pre-market trade. You can see the iShares Silver ETF up 9%, ticker SLV, and that's showing that kind of same breakout move here. One thing to pay attention to in the silver trade is whether or not the dislocations in trading in the market will lead to a premium or discount to the asset values in each fund. According to data from Wide Charts, we've seen big moves here, 11 to 12% premiums and discounts in that trade, so something to watch there. And then watch all of these silver miners as well, guys. Check this out, Pan Am Silver, Wheaton Precious Metals, Hecla Mining, all up between 12 and 20% in the pre-market trade. And Becky, that's not even leaving, or that's not even looking at some of the micro small cap ones out there. Be careful out there, guys. Back over to you.
Okay, be careful, not just because of the snow today. Don, thank you very much. It's great to see you. Folks, that does it for us today. Does it for us today. We will see you back here tomorrow. Joe, I'll see you back here tomorrow, too. Right now, it's time for Squawk on the Street.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber, coming from a snowy East Coast in Times Square. Futures are solid, coming off that week overnight. The Reddit squeeze evolves beyond GameStop. It's a big week for EcoData and the second busiest week of Q4 earnings. Our roadmap begins with the Reddit-fueled frenzy, continued volatility for GameStop, AMC, and now silver, the latest target in the short squeeze.
Plus, Goldman calls it the biggest short squeeze in 25 years, but says investors still have reason for optimism as economic growth remains a key driver for stock prices. And speaking of stocks, well, they are looking to rally at the open. Investors seemingly set to shake off concerns about speculative retail trading after, of course, what was the market's worst weekly sell-off, Carl, since October. But we'll see if that rally continues once we open a half hour from now.
Yeah. It's great to have Jim back in the chair, looking great as usual, Jim. Let's talk about, I guess, some of what was written over the weekend. David Kostin's note is a highlight, just looking at historical short squeezes and the short Goldman basket, which, in his words, is the biggest squeeze that we've seen in more than 25 years.
Once again, David represents pretty much everybody, straightforward. And I think the most important page of his piece is the list of stocks that are short and the value, how much money is actually involved. What I did was I looked at the top 7, and you really come to about $70 billion. If $70 billion is going to bring down the stock market, then I say you've got an opportunity here that you wouldn't believe. And I say that because, in part, because I've got to tell you, Carl, while stocks are down a lot, the companies that had good earnings are down, too, along with bad because of future selling. David, you understand when you look at that list that you're really talking about some companies that know how to deal with this, particularly AMC Entertainment, where we've got Adam Aron offering at-the-money stock to be able to raise versus his $900 million bond deal. But they've got a lot of very high callable debt. That's really the only one there that is struggling to stay alive. GameStop is struggling for relevance. I think there's an opportunity. It's very hard to figure out what Ryan Cohen's plan is when he's very quiet. Bed Bath is an option, is one that I think is very interesting because there you have Mark Tritton making a very big turn, but you have people starting to say, wait a second, that one is really a company that can hurt when we return to regular time. So, I mean, we've got some that are valuation, David, and some that are actually taking advantage of the squeeze. American Airlines did that last week. So it's a creative way to be able to raise money. I'm trying to stay away from, we can, of course, talk Robinhood, but I'm trying to stay away from the notion that this is big enough to topple the market. And Kostin really makes that point. Kostin is excellent. Once again, he's neutral. He's trying to get it right, and he is unemotional.
Yeah. I mean, you know, this morning, and I want to talk with you about Robinhood as well, because I do find it fascinating in terms of what the future of that company is going to look like, Jim. But let's come back to this morning, and it's not about stocks, as you well know, and Carl knows. It's about silver in particular, which seems to be the next target of this so-called Reddit cohort, or the merry men, I guess you may still be calling them, Jim. I mean, yes. I don't want people to forget that it was weeks, if not months ago, that you started to really focus us on these Reddit chat rooms prior to them becoming so well known sort of nationwide. And we did so in part because of the enthusiasm for certain SPACs, some of the vitriol that you and I were both getting in terms of some companies in the EV space. But again, they're now focused on silver. We see what's going on with some of these ETFs. But Jim, when I look at this commodity, it's not necessarily one where there is a large short position in the commodity itself. Is there? Yes, hedge funds use short positions in the ETFs to help hedge. But it's an interesting dynamic here. Not quite sure how it's going to play out, although they are sending them up dramatically.
Yeah, people have to recognize that silver is while a precious metal, David, is chiefly used for LED. It's used for a great deal for autos. Obviously, it's a great deal for jewelry. When you take it away, you're talking about a market that is very small. There are only 2 stocks that are really investable. You'll see a lot that are trading. But Pan American Silver does have 17.5 million silver ounces. They failed to deliver on the amount that they'd like to do. They're predicting this year to do 22.5 million. That is actually very big. The other one that I find that is, let's say, worthy of investment is Wheaton Precious Metals. The stock is up big. They have 820,000 in ounces per year they intend to put out. And then everybody else, David, is really too small. Obviously, people are using the ETF silver. Do I think that they're misdirected in taking it up? I do think that if you think the GDP is going to grow, you might have something winning in silver, but it is GDP-oriented. This is the first thing that they have targeted that, frankly, has a limit because there's not that much silver out there. But at the same time, David, what it is used is not for ornamental. So therefore, you really do need a step up in business in order to make that invaluable. Carl, when we look at what they've written about, so to speak, and what they've talked about on Reddit and Wall Street Bets, I think what you're saying is, look, there's a lot of people who may think they're manipulating. I think they're just telling a story, telling a lot of stories. And you either believe, let's go back to Bed Bath. You either believe that Mark Tritton's doing a good job or you don't. GameStop, you either believe that Ryan Cohen has a plan to make it a Chewy or you don't. Chewy being the operative. And so you can say, well, listen, is GameStop Blockbuster or is it Chewy? I'm going to come back and say, please, false dichotomy. It's a company that can do well. It can reinvent itself with the money that it easily could raise. The idea that it can't raise money somehow involved with, say, the government that it can't. Well, look what Adam Aron's doing. I mean, he's able to do it very freely at AMC. So, Carl, obviously GameStop can raise money. Their mum, their silence, which I've called them several times, I find disturbing, if only just because, come on, you have a major move. Why not admit that it's a material move and come forward with your plan? Does Ryan Cohen have to come forward with his plan? No, because he's a member of the board. But I do think that GameStop is, let's say, being ill-advised in their decision to not talk. And they should come on the show this morning and talk.
Yep, you've been pretty consistent, Jim, in your diagnosis of what they need to do. More broadly, though, Jim, you talk about risks to the overall market. Today, Mike Wilson at Morgan Stanley comes out and says, look, the correction is here. Savita over at B of A talking about, for the third week now, Jim, more similarities to the year 2000. Heavy retail, euphoric sentiment, rich valuations, and as you pointed out a moment ago, negative alpha for companies that beat. Why is that not a concern?
Well, I think it's not a concern, and I think I love Mike. But when you look at 2000, David, I know there are 330 companies that failed in the period between 2000 and 2002. How do I know that? Because I was involved with litigation when I started TheStreet.com. What you need to recognize is the vast majority of those companies were not making sales, let alone earnings. David, you know and look at what's going on with the companies. Other than the most recent fintech and the SPACs, you're really dealing with companies with tremendous earnings power. I mean, if we take a look at what Facebook reported last week, we take a look at the remarkable numbers from Microsoft, the remarkable numbers from Apple. Those are not fitting with the Mike Wilson model. I really think that Mike is absolutely right when it comes to the SPACs. We had a guest talk this morning about a possibility of a SPAC. Now, 140 SPACs have come public, and either all have made money or done nothing. So that looks like free money to people, and it may turn out to be, David, but you know, and I know, that free money for a small size is nowhere equal to what happened in 2000, 2001. I think Mike Wilson is suboptimal in his analysis because I think it scares people, and that's certainly not my goal.
No, and I tend to agree with you, of course. We can talk about the multiples on companies like Facebook growing its top line at an astounding still 33%, at least it did as of last quarter when it reported last week. At the same time, Jim, there are pockets of speculation in this market. I don't think we can doubt that in any way. We're looking at some of them right now. I mean, you're talking about GameStop like they would actually, like this is normal. I mean, this is not normal. This is crazy, at least from a valuation perspective.
Yeah, look, you got to go back to the late, unfortunate Paul Raines, whom I was close to and came on Mad Money many times, friend of Ken Lango. And, you know, Paul was trying to shift model after model after model. He ended up being a swag model. They have 5,000 stores. What are some of the innovations? That they could use those as warehouses, as like what Walmart does, but that's really not doable because you don't go to a mall for a warehouse. You could say that, listen, they have possibility of what the hell? I mean, they could take $22 billion market cap. They could easily do a takeover for our old friend Zynga, David. They Take-Two's too big, EA's too big, Activision Blizzard's too big.
I don't know if Zynga wants to take the stock.
Well,
I don't know anybody wants to take the stock right now, Jim. I mean, you know,
No, I'm trying to
listen,
take the stock down to the
in some ways. I know, but we're spending too much time on. I mean, listen, silver is fascinating to me today, as is the future of Robinhood, of course, the platform by which many people were locked out of buying GameStop late last week, which obviously led to that significant one-day decline. It's interesting how stable the stock seems to be now. We'll be watching it through the course of the day here, and obviously we'll be watching all the silver. But what about Robinhood, Jim? Because that to me is also a fascinating part of this overall story. A company that suddenly realized, yeah, we're in the technology business, but you know what? We're also in the financial business. And boy, we need to have a lot of capital. In fact, we may be in a somewhat capital-intensive business because we're being asked to put up a lot more in terms of making sure that we don't have negative equity in people's accounts and get hit with a huge loss. And so they went and they raised $1 billion from their existing investors. They raised $500 million from banks. I'm hearing they're probably going to need more and back to those investors as well. But it sort of does make you wonder what the overall business model of the company is at this point, given they've realized there's a lot of fin in fintech.
Yes. Well, David, I've been in contact with Robinhood this morning, and obviously, they've got a message of how they make their money, and we can just very quickly check it. They make their money, and they talk about how it's, the sources they make money. Robinhood's mission is to demonstrate democratic. They keep talking about that. But, they are able to do commission-free trading. We know that. But, David, there's no free lunch. They income generated from cash, but they also get some money for what they trade. Now, Vlad Tena, the CEO, has been very active in saying that he thinks that you get the best price. So I am not going to say he doesn't get the best price. I am saying that the idea that he does is really up to whether an independent group, say a regulator, decides that. As much because I think that it is important to talk about how there are capital requirements. Now, Vlad's new to the game. I enjoy him. He's been on the show very many times. To be new to the game, David, is also being new to the idea. You said that they do naked options. But what happens if you take the common stock off? Doesn't become a naked option. They don't really, they don't get money from order flow. But what happens, David, if the spreads get really wide? And Citadel, now I'm talking about the clear. Yeah, well, why don't I play a sound on tape from December from when I had Vlad on, where he was really worried about the SEC and the agreement.
We've taken a lot of major steps to ensure our compliance program is industry leading. And we've addressed, we've made improvements to the way we communicate payment for order flow on our various revenue streams, including a new section of the website where we give consumers statistics about execution quality on the platform.
Okay. Well, there's something interesting, David, because it is true that Robinhood gets payment for order flow cheaply, I believe, from Citadel, but we're not sure everybody else. But, David, I think the problem here is that the spreads widen dramatically. So it's entirely possible that the company did make more money, and you may not have gotten the best price. Obviously, they think that's up to dispute. But what's not up to dispute, David, is there are capital requirements. That's why I say this is a regulatory issue. It's not a systemic issue. And it would really behoove Gary Gensler, who's brand new, obviously, SEC chief, to just explain the idea that there are regulatory reasons why Robinhood might be limiting things. Not that Robinhood's trying to hurt the little guy. They're not trying to hurt the regular guy. There's 17 million people. But, David, the problem is that there are other alternatives. And I think that the idea that you are so-called stuck at Robinhood when 40%, a huge percentage of the money that left Robinhood went to Square. So I think you have to recognize that while everybody is concerned about Robinhood, being concerned about Robinhood is really being concerned about systemic, not systemic risk, but regulatory risk. Regulatory risk is not as important. Carl, well, the reason why I'm making this perspective is because when I see stocks like Facebook, which David mentioned, or when I see some of the stocks that are trading on, let's say, a matter of revenues, like ServiceNow, which reported a really good quarter, or even a PayPal, you go into a Square, it's very hard to refute the fact that maybe these are the new way, new banks. So, you have the Tesla combination. I want to find the next Tesla. You have the Chewy combination, which is obviously double the market cap of GameStop. I want to do the Chewy. And what happens is that if you're reading in Reddit, you're reading Wall Street Bets, there's no reason to think that these things couldn't happen. But they're an odd situation, ODDS. They're less likely to happen. And if you're buying the stock, you kind of hope that there is a master plan. If you're buying AMC, I like that. Why? Because if you think that we're going to have 50% of the people vaccinated, then we actually may have people go to the movies. The more stock that Adam Aron offers, the more likely the company stays in business. So he's a very smart guy, and he's doing at the money. Why? That's what GameStop should do. But it's important. Let me just say before we get too caught up, I am so glad to be back. I love everybody at this network who's doing such a good job. And I want to also make this clear. On Friday, it was not a vast conspiracy to keep me off. It was just simply the idea that it's harder to take off a Foley catheter than you realize.
Jim, it did not sound like a pleasant week for you, but we're so glad that you're looking and sounding great because we needed you those couple days that you were indisposed. We'll get to a lot of the calls that Jim is mentioning. In fact, this new street high on Tesla out of Piper as they go to 1,200, plus some downgrades of Disca, Viacom, Moderna, Ford. We're back in a minute.
I think sustainable tourism will mean for the future that travelers are going on short-haul trips and not choosing long-haul travel. Sustainability will mean that probably people will travel less or spending less money for air travel, and maybe some alternative traveling methods such as the train will play a larger element in the future. All destinations who are looking for solutions which are kind of out of the box, they will survive and they will be the first one to regain tourism and to see international travelers again. We said it before, the pandemic has changed everything in tourism, and the time to see that and to believe that will come in 2021. So we have to be ready for a new phase of tourism.
And these are the stories you should be checking out on CNBC.com. The social media fueled trading mania has found another target, silver, sending the spot price and mining stocks soaring. Some Reddit users, meanwhile, are urging retail investors to target ETFs backed by silver bars. That story's on the website now. China could surpass the U.S. as the world's largest economy a few years earlier than was expected due to its rapid recovery from the pandemic. The latest GDP figures show if the yuan strengthens a little bit further, the catch-up could happen as early as 2026. Head online for the full story. And Ryanair is forecasting a record full-year net loss of nearly 1 billion euros, adding it is impossible to give guidance for 2022. The low-cost airline warned the pandemic was wreaking havoc on its business after third-quarter revenue fell by 82%. Check out that and more on CNBC.com.
Keep up with the crisis. Squawk on the Street on CNBC.
What's happening with GameStop is just a reminder of what's been going on Wall Street now for years and years and years. It's a rigged game. We need a market that is transparent, that's level, and that is open to individual investors. It's time for the SEC to get off their duffs and do their jobs.
That's Elizabeth Warren over the weekend on CNN as more voices add to the conversation about short selling and Robinhood too. Jim, you mentioned Vlad before the break. He does write an op-ed in USA Today today saying we built Robinhood to provide access to investing for all, as Senator Warren implies. It certainly wasn't because we were trying to help the hedge funds.
Well, look, I mean, I don't think anyone can dispute Vlad's comments. Vlad Tenev, the CEO of Robinhood, but here's what I worry about. I've had Senator Warren on Mad Money many, many times, and she certainly does represent democratization. But I also don't want anyone to feel that the market is rigged. And I say that because let's take GameStop. Was it rigged in favor of people who were smart enough to go up against a hedge fund that had to cover? Let's take the case of AMC. Is it rigged with the idea that perhaps because the stock goes up, AMC can stay in business? So I prefer to not use the word rigged. Why? Because it's too inflammatory. I would like to say that there are many voices and that it's not necessarily manipulation until it's proven. Do I want everyone to do well? Oh, Carl and David, we know. We want everyone to do well. Do I favor the regular investor? Yes, I have to. It is just it's been my love since I got into business in '79. But I think what matters, David, is that it does not do good to inflame. It does do good to look for value and decide what may be too high so that you can ring registers. There's a lot of ringing register situations, David. And I think that it's incumbent upon people to recognize that while prices can fluctuate, as J.P. Morgan said, we certainly would be in a situation to say the fluctuation is geared toward one side or the other, because then I'm concerned that people will leave the market, as they did in the flash crash, as they did in the 2015 experience with China, as they did with the ill-fated 2018 VIX situation. So my goal is to try to keep people in the market and to make it so that people don't think that it is a rigged game, but it is not a game. It's an investment in trading business that some people are better at than others. And David, that's life, isn't it?
Yeah, listen, when you're Robinhood and you're asked by your clearinghouses to put up more money, you've got to put up more money. Mr. Tenev made that clear in a conversation, I guess, that he had over the weekend on something called Clubhouse with Elon Musk, saying they were asked for $3 billion. Now, obviously, they were able to raise a good amount of money. As I've said, they probably will need to raise more. But that's not about a rigged game necessarily. That's simply about trying to preserve your business in some fashion. You know, I do wonder, Jim, if Robinhood were a public company and we watched it last week do what it had to deal with, what it was dealing with, and come under such stress that it needed to raise more money, what would have happened to its stock price and the confidence in the company? It may, in fact, be benefiting from the fact that it is a private company as of now.
Well, David, you raise a great point. Apparently there was a book that went around. Now, again, did it come from Robinhood? I believe, but I don't have the facts, which I don't want to say that I'm misleading. I'm just saying that there's a book where they were very Spartan in trying to give you their profit and loss. You know, if I were Robinhood and Vlad Tenev, I would just send that to us right now and say, look, here's how we're doing. Now, you don't want to necessarily hide behind private. Why? Because you have 17 million customers. Is it possible that they get a takeover bid? We can't speculate on that. But what we can say is that we need to know how much money they had, and we don't want this to be a decision that people say, well, this was Robinhood being prudent. We want this to be able to say that it was the government urging Robinhood to be prudent. But, you know, David, we don't know that. What we do know is that they needed capital, or else they would not be in the situation that they're in. It's not their fault that they needed capital. It's what regulatory requirements. And, Carl, when we get into this type of thing, again, we get into this vast conspiracy thing. That's painful. If you're a broker-dealer, if you're a Robinhood, you need to put up capital. I mean, could we like to hear from Ken Griffin, who owns the Citadel? Remember, this is not the Citadel side that is the rich hedge fund. It is actually a clearing corporation. Sure, that would be helpful, too. What would really be helpful is for people to come on and tell us what's going on.
Well said, Jim. Well, we hope to learn more this week. We'll take a break here. We'll get to a lot of other issues for people that are not necessarily in GameStop, such as some of these COVID trends, which are quite encouraging. There's news on stimulus today, SPACs, as we kick off this first day of February. Don't go away. Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
First day of a new month as the Dow and the S&P come off of a losing January. Dow is looking for a reversal lower in the past 6 to 7, and it might get it. Futures are green. We're back in a minute.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
China is the most important EV market and will continue to be. So for our market entry in China, we go through a joint venture. Geely and another local government in China will be partners. And we are really happy that Geely decided to come in, because Geely is doing more than 2 million cars a year. There's a huge supply chain and economy of scales behind it. And we will bring in our internet technology and our connected car technology.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and, of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app, and subscribe to the Halftime Pod today.
A minute and 30 seconds before we get to an opening bell, Jim. Time to squeeze in a mad dash. Nice to have a name we haven't talked about in a while. Skyworks Solutions.
Well, I'm picking Skyworks Solutions. Why? Because I had the fortune to be able to be not on my back but on my side during last week. And when you're desperate for reading, what do you turn to? You turn to the conference calls and you turn to what people are saying about the tone of business. And the best conference call last week, by far actually, was not Facebook, which was excellent, not Microsoft, not Apple, but it was Skyworks Solutions. And why? Because they are very much in the Internet of Things. They're very much in auto. They're very much, obviously, in 5G. And the number they reported was just spectacular. Now, Mike Wilson, as much as, again, I admire his work, he should look at a Skyworks. Best number, 16 times earnings. Liam Griffin doing a remarkable job, and that's what I'm looking for. Now, does GameStop obscure this $27 billion company? Well, if that's happening, that's a shame. We can go over some others, but I'm just picking that one as being the single best in a week that was heavily related to some very, very good quarters.
Let's get the opening bell here, guys, and the S&P 500 at the bottom of your screen as we kick off, as we said, the month of February. Jim, a big part of Morgan Stanley, Mike Wilson's bearish thesis this morning is what he's calling a peak in the growth of M1, M2, that is money supply, which sort of brings us to this discussion that 10 GOP senators are expected to have with the president today about their new compromise of about $600 billion.
Yeah, I think that's really important because while Mike Wilson's looking at the current picture, let's not forget that the hedge funds de-risked about $1 trillion last week. That's very large. There's $5 trillion on the sidelines. Are the margin numbers too high? Absolutely. If you ask me what the root of evil, so to speak, in the situation was, the easy margin that everyone made, including some companies that perhaps lost track of the margin, that's definitely true. And I wish that there were more people who were more prudent about borrowing money, because that's how you lose a great deal of money. But if they're going to be stimulus checks, if we're going to have another round related to COVID, then I think the idea of M1, M2 as being the focus may be wrong. What the focus is what people do with their money when they stay at home and they get a check and they have a job. David, one of the remarkable things that we're discovering right now is what I call the May fulcrum. If 50% of the people are vaccinated by May, will they stay home or will they go out? And if you think they're going to go out, then we have to buy a whole different group of stocks. And, David, I think that that's not in the hands of anyone on this show. It's more in the hands of the public health situation and what President Biden is going to be doing with the dispersal of the vaccines. And I think that's, frankly, David, out of our control.
Yeah, I would seem to be. And, of course, we are still, despite our focus, of course, on that name there and the new dynamic in this market, Jim, we are focused on the distribution of the vaccine. There's a lot of concern as well. Thankfully, by the way, hospitalizations, new cases coming down dramatically. That's a good thing. But there is that continued concern about these new variants and as to whether we can win the race to essentially vaccinate enough people so that those variants are not going to bring us back to levels that we recently visited when it comes to the virus, Jim. I think that's a key concern. We can only sit back and watch and hope for the best.
Yeah, I think what was the news last week? It was J&J, which is possible that they have as many as 1 billion vaccines, but obviously their number at various levels is 66%, say, in terms of efficacy. But David, 66% is better than nothing if you're 50, 40, 30. So what we're looking at is absolutely, it's a foot race. I don't think the good guys are winning right now. I think COVID is winning. But I do think that what you're trying to do is you're trying to close the gap and then pass the gap. And that has a lot to do with the efficiency of being able to distribute the vaccine in any way that is not what I regard as being political, but it's much more in the hands of, say, the CVS's and the Walgreens, where it was supposed to be initially. You know, I have that Thermo Fisher on tonight, and they're the principal PCR firm. We have to talk about the idea of the antigen test versus the PCR. I know it's old hat at this time, but Carl, what we're really trying to do is make it so that fewer people are in the hospital, and we're ultimately looking for a pill, not some sort of infusion. Look, and there are many at stake there. Regeneron, Eli Lilly. Does Eli Lilly work against South Africa? Does Regeneron work against everybody? Those are therapeutics. But I think, Carl, I don't want to lose sight of the fact that it's COVID that's driving things, not let me get some companies that people think maybe GameStop, Beyond Meat, Stitch Fix, SunPower, Lemonade. I always like that one. Fizz, you know, that's LaCroix or LaCroix, depending upon whether you're educated or not. And, you know, if that's really what we're talking about, then I think what we're talking about is something that's incredibly fun, but not something that is going to be helpful for people.
Yeah. As Steve Leisman pointed out this morning, Jim, Morgan Stanley saying we've gone from putting 20% of available shots into arms to 50% in 3 weeks, and it looks like we can go higher. And even Dr. Gottlieb this morning talking about the variants and the challenge for vaccines. He says, I think we're going to stay in front of this. I do want to get you on Tesla because Piper did make some news as they go from 515, Jim, to 1,200. It's a 100-page report on Tesla, basically looking at 9 million deliveries by 2030. May take decades before the company runs out of opportunities. What do we think here?
Yeah, it's right about where the Battle of Broden came in and War and Peace. It's pretty easy, meaning that it is a long and convoluted argument. Here's what I think is completely unnecessary. On a day like today, to come out and say, look, this is the stock to buy. Using 515 goes to 1,200. Is Piper being irresponsible? No, but it's they're having Alexander Potter, moving his price target that way makes people feel like, wait a second, what do we pay? David, I know you'll love this. You get 9 million units from Tesla in 2030. What's that worth? Well, here we go again, David. This is the Tesla. This is the Chewy. This is the Amazon. This is the Netflix. I put Chewy in, obviously, because Ryan Cohen's now on the board at GameStop. Is this important right now to do this? Tesla at a quarter. People weren't necessarily in love with Tesla because of obviously, maybe the gross margins weren't that good, but they're going for volume, and they make money per volume. I just wish that there was a moment here where people would just take stock and say, you know what, this may not be the principal time to be able to push Tesla, only, David, because that's part of the morass so many of the regular investors find themselves in, trying to find the next Tesla, which then leads to the SPACs, and trying to find the next SPAC that looks like a part that goes into a Tesla, or whether it goes into a hydrogen engine, fuel. Plug Power did a very interesting secondary last week because they want to be able to make it so that they are not beholden to the oil companies. And, David, if Tesla is the next big thing, if not already, then what do we make about Exxon? What do we make about the idea of Exxon and Chevron getting together?
Yeah, good lead-in. Thanks, Jim. You know, listen, they may very well have had a conversation or two last year, as the Journal reported. I've been hearing some chatter around about it, did not, frankly, follow up on it, in part because it's hard to imagine even now the antitrust arguments against a deal that would bring together Exxon and Chevron. For Exxon, the focus right now, of course, is their conversations with the activist investors who are in the stock and where that's going to end up in terms of some sort of an agreement on both capital expenditures and operating expenditures. Will there be a new member of the board or perhaps even two? We should get some clarity on that from what I'm hearing, at least perhaps as soon as weekend, or at least part of it. It may be sort of staged in terms of things we hear there. But that's kind of going to be the key thing for Exxon shareholders. But, Jim, I'm glad you brought it up overall because, of course, you know, given everything we've been focused on, not just last week with GameStop, but yet again today with the silver companies, or I should say the metal itself and the silver ETFs, we've lost sight of some big stories, including last week, Jim. You were not here when GM said, oh, yeah, gasoline-powered vehicles, we're not going to make those anymore after 2035. I mean, this goes into the entire argument you were making or talking about when it comes to Tesla and its future. GM is going to be a key competitor. There's no doubt about that, given its entire lineup will be made up of EV as of 2035. It's only 14 years away for those like me who may be hard-pressed sometimes on math. So, you know, you've got this part of the market that is a focus for investors. GM, EV overall, SPACs. We've got another one today, for example. Tuscan is its name, this one. Doing microvast, Jim, EV battery technology. It's already in the market. They tell me they powered about 30,000 commercial vehicles and they have about 100 million in revenues. It's about a $3 billion deal and it will provide 822 million. There it is. You can see how it's performing. Of gross proceeds to microvast. But Jim, this has captured the imagination of many investors, far beyond GameStop in some ways, wouldn't you argue? And at least you can make an argument here that while there will be winners and losers, there certainly are going to be some winners in what is a vastly, well, not underserved, but a market that is growing extraordinarily quickly given the targets of some of these big companies.
Yeah, I mean, a lot of these people, I've been focused on Northern Genesis, for instance. It's Michael Hoffman. It's a Hoffman trade. It's a blank check company, and they've been able to, are they going to merge? They're not going to merge. That's one that could come out on top. You know, we've talked about EV batteries that are better than Teslas. But, David, I think the bottom line here, well, before we leave the Exxon-Chevron talks, is these are two companies going in different directions. Exxon's trying to preserve its business model, trying to preserve its dividend. Chevron actually had a pretty decent quarter on Friday, if you want to talk a loss as a quarter. Mike Wirth has done much more to be able to grow production. Now, I have been a believer that if you have to own oils, you can own Chevron, you can own Pioneer because they're growing production. But aren't all of these different SPACs and all these different companies, David, designed to make it so that oil is a much, that petroleum is a much shorter bridge fuse than a lot of the oil companies can have. And that's really why, if you're buying Chevron, David, maybe the bridge fuse went from 2035 to 2030 because there's so much money coming to all these different alternatives, David.
Agreed. I mean, there is a direct connection between GM's decisions and, of course, Tesla and the growth of EV, which still continues to be an infinitesimal part of the overall market in terms of sale of automobiles around the planet. But we know, Jim, is going to grow dramatically. Now, they will tell you, of course, their product is not just used for automobiles, but it is a key part of their revenue stream. So these companies are got to figure a lot of things out. Jim, I don't know if it ends up that they buy a lot of these battery companies. Perhaps that's the bid eventually and where they need to go, given energy overall is the business they're in.
Well, you know, it's really fun. If you take a look at what Andy Marsh has done at Plug Power. Let's use that as a template. Hydrogen has been completely, David, completely out of the mix. It's very small. Green hydrogen I'm talking about. Why? Because it's too expensive. But the power of electricity's come down. You need that. There are companies that are furiously trying to get this to be a fuel where it's the greenest of the carbons. And, you know, do they make it? Or are we going to stick with batteries, which is a plug-in system? Whatever's happening, David, the thing that we don't want to lose sight of the fact is that the fossil fuels are hated by companies. So when you're dealing with an Amazon and a Walmart, those are your core customers. And they are saying, listen, we have to lower our footprint. So FedEx, lower your darn footprint. And that's going to come to needing these companies. Carl, it is the customer that is driving these things, not the investor, but the customer that's saying we need to meet our goals to be carbon neutral. And in order to do that, we can't use carbon engines that involve fossil fuel, which is why the so-called mania may not be a mania. It's an attempt to be able to meet the customer's demands, with Amazon being the leader and Walmart being number 2.
Yeah. As David said, or just a remarkable headline, from GM that got buried last week. 2035 is not that far away in the grand scheme of things. Jim, on Friday, Morgan Stanley did take Ford to sell and took GM to 80 as they began to parse out the opportunities on EV between some of the legacy manufacturers.
You know, I have trouble with that call. Now, my charitable trust owns Ford, but what you're doing, again, is you're looking at Jim Farley as a static individual, as his CEO, when he's furiously involved in a lot of different aspects, including electrifying the very popular, well, most popular Ford F-150. Do I think it's a mistake to sell Ford? There are other things that work, including the deurbanization of America because of COVID, the fact that Ford has decided to get out of making cars where they don't make cars. And so I think that one is misdirected because it presumes that Jim Farley is just another Ford, just another person who's not a Ferrari but a Ford. Jim Car Farley, as they call him, is very much, David, involved with making modern cars and not losing money on cars. So why do we take that to a sell other than because it's entertaining?
Yeah, all right. Well, you've been a big proponent and been dead right on Ford, and obviously very enthusiastic about the leadership of Mr. Farley. You know, I do, Jim, though, want to come back to just this overall point on EV overall. You know, there are some similarities to the enthusiasm we saw around the internet in the mid to late 90s, and the companies that were going to benefit from it. And of course, some of them are still with us, such as Amazon, for example, one of the greatest companies. I mean, if you'd bought a basket of stocks that included Amazon, you probably are up, despite the fact that many went by the wayside. There are going to be so many things that need to change over this next decade, including, by the way, even the ability to generate power in this country, if in fact we are having all these people plug in their automobiles to charge them. The battery technology, the power that we are going to need. It goes on and on from there. So, Carl, there is going to be a very interesting opportunity here, and certainly it's reflected to a certain extent in the enthusiasm many of these stocks are met with in the marketplace. So many of these EV companies choosing to go public via SPAC fairly early in their development cycle.
Indeed. We did get an upgrade of Nikola today out of Webbush. Got some delivery figures out of NIO as well. In the meantime, guys, pretty narrow range. Another day of narrow ranges on GME. Let's get to Bob Pisani. Hey, Bob.
Good start to Monday, Carl. 4-1 advancing to declining stocks. So once again, there is this sort of negative correlation between the markets and most shorted names. When they're down, the market tends to be up. And as on Friday, exactly vice versa tends to happen. So if you look at the sectors, you know what? This looks like the reopening story to me. So once again, what was the old market leaders? Semiconductors and China. What's the old market leaders today? Semiconductors and China. Industrials too. Banks too. What's lagging? Defensive names like consumer staples. This is the reopening play. Now, if you look at our heavily shorted friends that are out there, mixed today, but generally to the downside. GameStop, as Carl mentioned, moving in a much more narrow range down. AMC is the only one that's really up there. Unusual situation here, moving in opposition to the other most shorted names, Bed Bath & Beyond, Express, also to the downside. So you see that sort of negative or inverse correlation with the markets, I think, is continuing here today. As for all this speculation about silver, I have no idea about it, but Can I point out silver is a very heavily regulated commodity. It is silver futures are regulated by the Commodity Futures Trading Commission, and they can and do routinely change margin requirements. They did it most recently on August 11th. You can see that little circle there in the middle. Silver plunged 11% on August 11th. Gold did as well. Why? Well, because there was speculation about vaccines coming out. Gold and silver were moving in opposition to the vaccine story. So dropped, and the CFTC stepped in and raised margin requirements. They raised margin requirements for silver futures like 15% on that day. This is when it dropped. They stepped in. Now, my point is, they're not going to watch this thing go through the roof. They're going to step in and do something, and they would do it as part of their routine activities to ensure fair and orderly markets overall. So I don't expect a lot of dramatic through-the-roof movements here in silver. As for the markets themselves, the main stories are still well known to the market. The rollout continues for the vaccine. The stimulus is still, the debate over the weekend amongst traders I talked to is larger is more likely than smaller. So they're talking 1.9 trillion with the Democrats, 600 billion. And obviously the belief here is it's going to be towards the higher side, maybe not 1.9 trillion, but somewhere in the middle or a little bit higher here. Nobody thinks the Fed's going to taper in 2021. At least the trading community does not. And earnings, we're getting good beats continuing. The problem is we know most of this. The risk is on the downside for the market. The risk of this is not occurring. So what we need to see here is some nice surprises. So far, we've been getting the great surprises here. We see about 38% reporting on the earnings, 85% beating by about 18%. This is what happened in the third quarter. This is what the market needs to see. Pleasant surprises, much better than anticipated. And Carl, the good news is if you look at the first quarter, which is what we care about right now, the numbers are going up steadily in the last week. We were talking about 16% up in the first quarter. Now we're talking about close to 19%, close to 20% rise in the first quarter. Carl, that's really good news for the markets. Back to you.
Yeah, and once we start lapping some of these tough comps from when the pandemic hit last February. Thanks, Bob. Bob Pisani. We've been showing you some numbers at the bottom of your screen. That's manufacturing PMI a few moments ago. 59.2 for January. That's a record high for that particular number. New orders, 59.9. And coming up at the top of the hour in about 15 minutes, we'll get ISM and construction spending. We'll be right back.
Digitization is enabling is innovation, I think, across multiple areas. So if you look at fintech, for example, in India, I think the enabling of the UPI platform has created so much globally. Digitization has got a boost because of the COVID situation. And I think across our customers, we are seeing there's an urgency to transform their models to be more digital.
Daybreak in the US.
Frayed nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
I put all my money in GameStop, and I can't lose.
Uh-huh. So normally a stock price reflects a company's value, right?
Okay.
And 2 weeks ago, GameStop was valued at $17 a share, and then it went to $413 a share. Would you say that reflects the kind of business GameStop stores have been doing in the past 2 weeks?
We sell games?
Right, but are you good at it?
Not really. People download all their games now, so we're kind of like, I don't know, what do you call it?
A dying business?
Yeah, that's it.
It's the SNL crew over the weekend talking about GameStop. Jim, you and David and I have been through a few cycles, and when business news and stocks become part of the cultural zeitgeist, it's usually an interesting chapter.
Oh, no doubt. I mean, what's GameStop tried to reinvent himself many times. People need to go back when the late Paul Raines decided to make it, you know what, we're obviously going to be a victim of the download issue, which became cheaper. Let's call it direct-to-consumer. We've seen that happen in many different industries. Direct-to-consumer represented a pretty good way to go. But what is really fueling the ability for GameStop to be able to not come on and be able to make people feel that it's doing well? It's the shortage right now. The shortage that we have in PlayStations. The shortage that we have in Xboxes. Now, I went on this weekend to try to find these. They're very hard to get to. Right now, if you go to a Best Buy, you'll see a sign which says they're not available. Now, GameStop says that they have some when you go to the website. So as long as there's a shortage of the actual devices, I think people can say, well, you know what, maybe these 5,000 stores are a way to be able to get it. So should GameStop become a stock exchange, so to speak, for this material? I don't know, but that's another form. I stretch and stretch to find how I can get to the golden days of $50 to $60 for GameStop. People don't want to hear that, but I'm talking about the golden days, Carl, and that's all I can get to.
Yeah, well, watch it here. Close to session lows, guys. Along with the broader market, we're back to 37.30 as we didn't quite take out Friday's intraday high. Still early, though. Dow's up 100.
We have a vision for growth. We have a vision to be more relevant to our core market. That's why we decided to move our headquarters to Abu Dhabi, support of the Abu Dhabi government and the Abu Dhabi Investment Office. We believe that the Abu Dhabi infrastructure and ecosystem is more suitable for our next new phase of growth and more relevant for the region.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
Welcome to the closing bell.
It's the most important hour of the trading day.
We've got just about 36 minutes left to go in today's trade.
Minute by minute.
Partial recovery of what we lost yesterday.
Wilfred Frost, Sarah Eisen. Closing bell.
Some interesting price action in GameStop. Close to session lows here. Anything below 250 would take out Friday's intraday low. We'll watch that closely. More Squawk on the Street continues in a minute.
With a bang, energy and change came to every part of our universe. Seismic or small, it continues.
Change is all around us. Shaped by technology and human ingenuity. We can make it work for you and your business.
Is this going to be the presiding factor for the next couple of years or so? Or actually, do you think maybe 2022 it's going to be about the rest of your business?
We see, because of that, a very, very healthy development in Europe and in China. And we will see the United States coming back in the second half. COVID is a boost for modern healthcare, for a more digital healthcare, but in the end also for a more humane way of delivering healthcare.
Jim, and stop trading.
So it begins. KeyBank says, you know what, you want to be out of the nesting trade, which then means they take Lowe's Corp from buy to hold. Carl, I don't know, when you get to a May time frame and say 50% of the people have been vaccinated, maybe that is going to be a moment where the nesting trade ends. I don't think it's over, and I think these companies are going to do very well if you get a stimulus check. So I'm going to take the other side of the KeyBank call.
All right, Jim. And tonight, packed show, it sounds like.
Yeah, well, we've got Dick's new CEO. Ed Stack's turning the reins over to Lauren Hobart. She's sensational. We got to speak to her. Judy Marks delivers another good number. It's a guide up for Otis. Yeah, remember, that's the split off of United Technologies that involves elevators. And then, yes, the man of the hour, Mark Casper. He's been the guy who has done, I think, really the spokesperson for what the PCR machine does for COVID. He's been level-headed. I cannot wait to speak to him.
Jim, we will see you at 6 o'clock. Nice to, as we said, have you back in the saddle. That's Jim Cramer. Of course, Mad Money starts at 6 p.m. Eastern Time.
Thank you.
Good Monday morning, everybody. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. First day of a new month and a jam-packed week as we keep our eye on the Reddit trade, eco data. We got a Jobs Friday coming up, stimulus talks, SPACs, as well as vaccine hopes. Our roadmap begins with the Reddit rebellion raging on. GameStop, AMC, and others remain volatile on this first day of February.
Plus, call it a silver squeeze. The trading frenzy now making its way into commodities, with silver on pace for its best day in more than a decade.
And we'll have an exclusive with Charter Communications CEO Tom Rutledge announcing a new $5 billion plan to expand its broadband access. And, of course, Morgan reported earnings last week as well.
All right, it's going to be a big hour, but we're going to start with that Reddit trade. Mike Santoli has a look at what the squeeze stampede means for the broader markets. Mike.
Yeah, Morgan, it has meant actually plenty for the broader market. The volume and the volatility in just a handful of stocks last week was enough to destabilize portfolios and get alarms being raised in terms of hedge fund risk management models that it did cause selling in unrelated stocks. But the real point here is it's not really a scalable enterprise to go after these very ripe short squeeze candidates. There's about maybe a couple dozen heavily shorted stocks that seem candidates for this. The overall market short interest is, I keep pointing this out, is extremely low by historical standards. We're probably at a 15-year low in terms of the amount of short interest relative to the market cap. So it's not as if this is a heavily shorted market that hedge funds have been pressing their downside bets on. That's one thing to keep in mind. Now, there's still this repositioning trade that's probably still going on with big investors basically just reducing their risk levels all around, going to a neutral corner. So has this purge really worked its way through is the big question. Down 3.3% in the S&P last week. A lot of it had to do with that type of activity. No real way to know if it is done. They don't really ring a bell after that's finished. But I do think you can look to other markets to see if there is evidence of stress spreading outside of equities. But that's not really happening right now. The Treasury bond market has been pretty tame. The yields have held above 1% on the 10-year. Credit spreads have not really been disturbed by all this. So right now it seems like a violent equity repositioning trade that's underway. And, you know, again, it could actually matter if these stocks calm down a little bit, because last week, by some estimates, more than 5% of overall volume was from about a half dozen of these stocks with 50 to 100% daily volatility. That's going to make a dent, even if it's very, very small in terms of market cap compared to the overall market, guys.
Mike, I want to hone in on this quote-unquote silver squeeze that we're seeing right now. I mean, obviously, we saw futures prices jump, highest level since, what, 2013? Might even be earlier than that now. But when you talk about the SLV, that silver ETF, and I know this is a point that you've made, unlike maybe some of these standalone stocks, it can much more easily issue new shares. What does that do to the movement, or I guess the volatility that we are seeing or could potentially see in that name? Yeah,
these exchange-traded products are built to be able to flex their share count in response to supply and demand. It's not something that can happen in an instant, but there are these authorized dealers, market makers, who can create or redeem shares in the trust, of course, in exchange for physical silver. So at some point, it's absolutely limited by the ready supply of silver bullion, you know, in the vaults and all the rest of it. But it's not as if, you know, there are people who are short the SLV and they literally only have access to the shares that are already trading out there to cover those shorts. It's a little bit of a different story. Plus, of course, the silver futures market's so much bigger. This is well beyond the scale of just these isolated small to mid-cap stocks that have been run in this fashion. So definitely a test, if in fact it even is mostly kind of an amateur's retail push to get into silver.
Yeah, that's interesting you said that, Mike, because that was my next question, and you sort of presaged it by saying, even if it is. Right. I mean, there is a sense that there are also some large investors involved. Perhaps last week with GameStop, and certainly it would seem with this move in silver. You know, I don't know what you're hearing. We can only sort of look at it anecdotally, but it continues to be a theme, at least, or a question, I guess.
Without a doubt. First of all, you can just look at some of the trade sizes I was hearing last week in some of these stocks like GameStop. You know, these call option purchases that are pretty big ticket. Now, look, it could be people who have big profits in this trade that are just kind of doubling down. But I do think that you can basically infer from the fact that any time you get an instrument moving this violently, and anytime you get this much public flow into certain areas, the algorithms, the quant traders, they're going to seize upon it, and they're going to try to trade with it or against it. So it's fair to assume that. Plus, when it comes to silver, I mean, this is a market that's always susceptible to sort of, you know, a little bit of hype, a little bit of conspiracist thinking. There's always promoters in silver out there that are saying it's the poor man's gold. There's a shortage globally. I mean, perpetually, that's been the story. So it's not surprising if they would try to bolt on to the social media energy behind this to see if they can amplify that message.
Mike, you've been covering the online brokerages for years. I wonder if you think there's going to be any kind of, I guess, reckoning or change or shift to the business models we've seen in place.
It's unclear at this point, Morgan, honestly. I mean, it's interesting that there's so much scrutiny of the revenue models and payment for order flow and things like that. And there are differences, right? A Fidelity is not the same as a Robinhood in terms of how they access the markets and actually execute trades. But I do think that what's fascinating is it has absolutely never been cheaper or faster for individuals to trade or to engage in the markets. Now, there are ways to improve it. There are ways to make sure it's more fair. But to me, we have these massive wholesalers who are invested in all this technology to make markets and stocks and essentially just try to ride the bid-ask spread. And that's been okay for a while now. If you want an asset-light company that just gives you an app for free trading, they got to make it somewhere else.
Mike, a good overview of where we're going to start the week. Thanks for that. Our Mike Santoli, senior markets commentator. Let's continue that conversation with our next guest. Founder and CEO of the Rock Creek Group, Afsaneh Beschloss, also sits on the board of the Global Alliance for Vaccines and Immunization, something we can also talk about. Afsaneh, thanks so much for the time. It's good to see you.
Good to be with you.
So our viewers are being handed all this information over the weekend about the degrossing of hedge funds, the biggest week since 2009. Can you describe what you think the impact is potentially on the broader market because of that?
It's a really interesting February 1 today, and a couple of things worth mentioning is that everyone has been talking about the democratization of the markets, the smaller investors having ability to get into the market, to get access to leverage much more easily, but also the fact that technology and social media have entered financial markets in a much bigger way. The really interesting thing I thought that we've been hearing more recently is that it was not just the small investors who have been taking advantage of the run-up to GameStop. What was really interesting over the last week was also to watch some of the family offices, some of the very large tech entrepreneur families might have been also in the trade. And I think what Mike was saying earlier, which is this size of larger tickets that we're seeing on the markets, might be showing that it's not just the small investors jumping on the bandwagon, but also the more sophisticated, larger investors who are not being talked about. I think the really, really important thing is probably the Biden economic team and the new regulatory team are probably watching this very carefully, because finance is supposed to be becoming more inclusive. But is it truly becoming inclusive? Because if the small investor is to be protected, you need to make sure you have much more transparency on shorts, which we don't have right now. You need to have much more transparency on the economic model, again, that you were just talking about, of these brokerage firms, many of which, again, benefit from, for example, selling the flow information and this flow of their orders to the financial markets.
Right. Does that whole stew of retail involvement, when you combine it with rich valuations, you combine it with the hopes for earnings that appear to be even higher than companies are delivering, does that make the market feel toppy for you right now?
It does.
You know, we're looking at EV to EBITDA, and there are many companies, even we know that Tesla has a higher number than GameStop, but obviously it has a very different economic model. You're seeing a lot of really interesting movement in a lot of the more impactful energy stocks, right? In the renewable stock market, there were some corrections in January. I think, there is a lot of liquidity sitting on the sidelines. And what is really, really important is as small investors start to get more into this market, make sure that the same level of information is available on valuation and true earning ability. But no question that the forces that are pushing the market are not just economics 101. It's not just supply demand. It's not just what we were used to before. And we need to start being much more aware of these other forces.
Afsaneh, it's Morgan. I wonder if you think the retail investors are here to stay, especially if you start to see some of what could be very violent and fast profit taking in a name like GameStop.
That's a really great question, Morgan. And I think the GameStop correction could lead to some losses, again, for those who entered the market much later. But I think retail market is here to stay. Even if you have a correction at this time, the size of the retail market is large. And also the fact that COVID may be continuing and keeping people at home for a longer time, I would assume that the power of the retail market will be there. And if regulators are sure to make sure that their interests are also met, I think you will see them continuing to play the market.
Upson, it's David. Obviously interested in hearing your predictions here in terms of what the long-term implications are going to be of this. When it comes to the hedge fund community, obviously we're all looking at the numbers for January. Many of them are horrible, although most of the firms are still going to be with us. But do you believe that hedge funds will still actually have single name shorts, or is that kind of going to become a thing of the past?
That's, what we're seeing is that in just the last week or so, the number of single name shorts has gone down, and the proportions between single name shorts and the index shorts has completely changed. So a lot of people are moving into index shorts just because even if you're sophisticated, even if you're very knowledgeable about a particular company, that might not be sufficient and relevant. And your risk management models obviously did not work well enough over the last 2 weeks. So again, I think for some hedge funds, you're seeing that they're moving into index shorts. On the other side, we are seeing very, very nascently, really over the last few days, that there are also the more successful hedge funds who can withstand this kind of situation. And they are starting to build out single name shorts, and they are looking at the very long game. So again, it's something that you will see winners and losers on both sides, both on the retail and the sophisticated investor, so-called.
Finally, on vaccine trends, I'd love to get your thoughts, because the optimists point out of all the people enrolled in all the data, all the trials so far, none have been hospitalized or died, those that have been vaccinated. On the other hand, the skeptics point out these variants are treacherous long-term and may at least elongate our path to immunity. What are your thoughts on that?
A lot is going on with COVID that is not even being measured sufficiently. For example, even looking at places like India, where it seems like infections are lower and no one seems to be really having a clear explanation for that. So I think on the negative side, as you said, are the vaccines going to be sufficiently effective? Everyone assumes that they will be to different levels, but these emerging more dangerous variants could also make this much more into a 3, 4, 5 year event, which is not really what we expected. I think that was not something that the general public expected even last week. So I think moving into February again, markets are going to start being much more cognizant of this being much more part of our lives. And that also until everyone is vaccinated, or a very large proportion of people are vaccinated, including the equitable distribution of vaccines, which has been something that has got forgotten, I think, is something that will be a very important part of the dialogue moving forward.
Yeah, obviously going to be another huge challenge in 2021. Sani, thank you very much. Covered so many topics. Appreciate it.
Nice to be with you.
Well, coming up, how should D.C. regulate the Reddit-fueled frenzy? Should it? We'll debate it next with a member of the House Financial Services Committee. Don't go anywhere. We're back in 2.
So Julius Baer has reported a 50% rise in full-year net profit. The Swiss bank boosted by robust client trading. Julius Baer also announced a share buyback program of up to 450 million Swiss francs.
We had announced a share buyback, which we had to stop due to the COVID pandemic and to regulatory action. We will continue on that path. We are very highly capitalized right now, and we intend to return that excess capital. We do this out of a position of strength.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Whether that is on the foreign investment front, whether it's on the national security front, as well as whether it's on the human rights front. And we'll continue to advocate and speak up for Australia's national interest. But that shouldn't preclude, strong relationships in the region. And historically, we've had a very good partnership with China, and would like to see that continue.
Squawk on the Street. Both the House Financial Services and Senate Banking Committees are poised to schedule hearings on the stock market after the recent spike from GameStop. We are now joined by Massachusetts Congressman Stephen Lynch, a member of the House Financial Services Committee. Congressman, thanks for being with us today.
Good to be with you, Morgan.
Given everything we've seen play out in the markets in the last couple of days, all of the uproar we've seen over how things have gone in terms of limits of certain types of trades, I wonder if you think the financial system is rigged.
Rigged?
Is it broken?
It's not fair, and now it's not orderly either. So I think we've got to take a whole new look at this. This is a real convergence, what we're seeing with the GameStop type trades and the, the democratization, I guess, of the markets. Some of that is very good. However, as we see, is very disruptive, and I do worry about systemic risk in the longer term.
When you say systemic risk, I mean, what specifically is jumping out at you, and I guess how is that going to affect or color the questions you ask at that upcoming hearing?
Yeah, well, we're still getting data, which is good, but we do know that one of the reasons that Robinhood explained that they were curtailing trading was because of the requirements that we had put in and that I had voted for, where there are reserves necessary in trading volume. So they're clearing requirements and posting collateral. They had to reach out and they had to restrict trading. If that is true, that's at least their explanation. So that type of discussion leads me to believe that there was some systemic risk present. Now, we'll get more information as time goes on.
Well, Congressman, it's David Faber. It could also be that their business model simply was not properly positioned for the current environment, and the regulations actually worked. Because if they hadn't been there, Robinhood might have collapsed.
Yeah, oh yeah. I'm not saying that the regulations weren't helpful. I'm just saying that, when we get 20 times volume on options and this whole convergence with, social media, fintech, the democratization that Robinhood brings, we didn't anticipate this, right? This is sort of an abrupt and almost a manic development that certainly Congress didn't anticipate, and I'm not sure that we gave the SEC tools that would allow them to deal with something like this. So that's what we have to look at.
Do you find that there is also sort of a populist nature to this that kind of echoes what we see in the political realm?
Oh yeah, this is Occupy Wall Street, and they have. So there is a strong element of that we see in Reddit and Wall Street Bets. So there's a strong flavor of that. Stick it to the man, if you will. And there's a lot of animosity towards hedge funds, some of it well deserved. So that's part of this, definitely. The question is, see, so many people have piled into this trade at this point. I don't think it's wise for Congress to try to pick winners and losers here in this trade. But I do think it's more important that we look at the integrity of the markets, that we look at the original mission of the SEC and make sure that make sure that they're able to try to maintain those fair, orderly markets.
So, Congressman, how much of the focus should be on Wall Street Bets versus, I guess, some of the more established players in markets right now? And I say this knowing everything is perfectly legal that's happened, in the sense that how a company like Robinhood makes money by selling its order flow, how market makers are then able to execute around those trades, on those trades as well. The fact that we have seen hedge funds and other investors be able to short a company short a stock upwards of 100% in terms of the interest and a pile on there. Is all of that on the table in terms of review right now, or is it specifically Wall Street bets?
I think you astutely anticipate the approach of Congress. I think you're absolutely right. We need to look at all aspects of that. Look, this is across the board, right? So many people have complained about the short selling of hedge funds and that activity, and maybe in the ecosystem of finance there is a role for short sellers. Certainly, when the vultures start to circle a company, it's a red flag to the market in general. But there has been a concentration, and some people have complained that these short sellers have glommed onto companies that otherwise might have been able to survive. And so there's an aspect of market manipulation that was already present. And now you have, this democratization move, and you have the small retailer combining. That's a huge power shift that had not been there before. But this is not a pump and dump this is not a garden variety pump and dump situation, I don't believe, because look, this is GameStop, right? They're a shopping mall retailer. We're in the middle of a pandemic. Mm-hmm. You can land a 747 jumbo jet probably safely in any parking lot in America. And so we know the dynamics here. Yeah. So obviously there's a lot more going on. And I do believe there is some sincere hope and belief in GameStop. That was the kernel of this, bringing in new people, making sure, trying to, be more digital and less brick and mortar oriented. So there were some fundamental forces on the upside, but then it became more of a political movement, and that's when we saw things go to 400 and change from $20. So clearly, this is a lot more complicated than people realize, and I do worry about the broader implications. I chair the subcommittee on national security. I also chair the task force on fintech, and I worry what our adversaries might be learning right now about our markets. The United States, we enjoy a primacy in our financial markets that are the envy of the world. And this shows a real vulnerability. So I'm trying to think down the line what this might mean.
Interesting. Well, we appreciate you coming on and talking to us about this today, especially since I know on Friday you did test positive for COVID-19. So we're wishing you a speedy recovery as well.
Thank you.
Congressman Lynch.
I had a negative test yesterday, so that's a good thing.
Well, that is very good. We're happy to hear that. Thank you for joining us.
Thank you, Morgan. Thank you, David.
Our pleasure. All right, let's get to our ETF spotlight now. We're going to take a look at the consumer discretionary group. The ticker there is the XLY, as many of you already know. It's up 30% over the last 12 months. It's been powered by its two top holdings. What are they? Oh, Amazon and Tesla. Yeah, that'll help on it. Speaking of Tesla, Piper Sandler raising its price target on that stock to a street high. It's now $1,200 a share, saying Tesla could have new opportunities to pursue for decades due to its target industries currently embracing outdated business models. Tesla already up double digits, of course, for this year, although not outpacing the gains of GM and Ford, amazingly enough. We're back right after this.
The countdown to the close of the European markets is sponsored by IG. And opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch, weeknights on CNBC.
Reddit trade today, including AMC, which is positive, but MKM does downgrade it to sell today, saying there's still $5.7 billion of debt growing each quarter, adds a price target of $1. More Squawk on the Street continues in a minute.
China is the most important EV market and will continue to be. So for our market entry in China, we go through a joint venture. Geely and another local government in China will be partners. And we are really happy that Geely decided to come in, because Geely is doing more than 2 million cars a year. There's a huge supply chain and economy of scales behind it. And we will bring in our internet technology and our connected car technology.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Here's your CNBC COVID update at this hour. Confirmed COVID cases in the U.S. are now above 26 million, although they continue to climb at a slower pace. Sunday's 112,000 new cases is the smallest we've seen since early November, excluding the unusually low counts on Thanksgiving and Christmas Day. As it finds more cases linked to the South African variant, the United Kingdom is trying to determine how widely it has spread. It's urging every person over the age of 16 in London and some other areas of England to get a COVID test, whether or not they have any symptoms. And UK Prime Minister Boris Johnson has tweeted that the entire country is wishing 100-year-old Captain Tom Moore a full recovery after his hospitalization for COVID treatment. The World War II veteran raised millions of dollars for the National Health Service as he walked laps outside his home, winning him international attention and a knighthood from Queen Elizabeth. David, back over to you.
Okay. Thank you, Courtney. The Reddit trade, of course, is making its way over into the commodities markets. That's something we've been following closely this morning. And we're helped by Leslie Picker, who's got more on that potential squeeze, I guess, in silver. Unexpected.
Potential. Yeah. Exactly. Spot silver, David, is surging, the price jumping to about $30, the highest level since 2013. Now, it's a byproduct, as you mentioned, of this latest push on Reddit to rev up assets and try and force a technical squeeze in those assets. Now, the idea to target silver took hold during the middle of last week, with the thought being that if they push up the iShares Silver Trust, ticker SLV, then they can force the ETF to procure more silver to meet the demand. There's also an element of, in these forms, of trying to bring down the big banks who are hedged against their physical holdings. Now, SLV is surging, as are silver mining stocks like Core Mining and Pan American Silver today. A key catchphrase on Reddit is buy physical. Now, this sentiment caused a supply squeeze over the weekend. Retail sites were bombarded with orders for physical bars and coins and had to halt orders yesterday. This morning, we spoke with Mike Whitmire, the CEO of JM Bullion, who said that he sold almost 1 million ounces of silver this weekend, whereas on a typical weekend, he'd sell 50 to 100,000 ounces. He said yesterday he had the single largest volume ever before he ultimately had to pull silver after his inventory was depleted. Now, in reading through the Reddit threads this morning, there is far more debate over silver than there was with names like GameStop and AMC last week. Some traders have pointed out that many hedge funds have long exposure to SLV. Some even believe that it's hedge funds masked as retail investors who are really pushing this trade. And then there's the issue of regulation. We've reached out to the Commodity Futures Trading Commission to see if they have a comment or if they plan to change their margin requirements or other aspects of this. We haven't yet heard back. We will let you know when we do, guys.
Yeah, Leslie, you've been following the hedge funds closely. Of course, you bring up the idea that perhaps they are not going to suffer as long short equity hedge funds did so. Some of them suffering greatly last week, given that move in GameStop and other stocks. Going through the numbers, anything stand out to you in terms of performance for January, and or will there be any implication for macro hedge funds that play in the commodities markets from this move?
I mean, my take in kind of getting the numbers over the weekend from a lot of the hedge funds that were implicated in this is that it actually could have been a lot worse. The fact that Melvin was down 53% for the month, I had heard, numbers far worse than that across the rumor mill last week, based on kind of them getting caught up in that GameStop trade. Same thing with Point 72. The guidance I had gotten from sources familiar with the matter was that it was between 10 and 15% for the month. That turned out to be 10% for the month. So definitely nothing to celebrate, nothing to write home about in terms of performance. But based on some of the conversations I was hearing last week, it actually could have been far worse than it was.
Yeah, perhaps other than Melvin, which has been severely damaged. Sorry, Carl. Go ahead.
No worries. No, I was just going to say the trade definitely developed late last week and is carried into the new week, Leslie. Thank you. That's Leslie Picker. As for short selling in general, it is something that the National Economic Council Director Brian Dees talked about over the weekend on Meet the Press.
So it sounds like you think short selling is bad for the economy. Is that something that should be legal?
Well, we're going to look at those issues and certainly understand fully this particular this particular episode and the broader questions there.
Let's turn to Andrew Calamari this morning, a partner at Finn Dixon and Hurling, former director of the SEC's Commission's New York regional office. Andrew, thanks for the time. Really appreciate it today.
Thank you. Happy to be here.
They've said they're looking at this. Can you give us a sense of how aggressive you think a look they are giving it?
Well, knowing certainly the New York office as I do, if they're the ones involved or if Washington is involved, my guess is they're all over it. I think the problem here is that a lot of the conventional theories for enforcement actions, trading suspensions, things of that nature may or may not exist here. But for example, is there coordinated trading going on where there are agreements among traders? Those are the kinds of issues that the SEC is going to be looking at.
Right. Where do you think is the bar at this point, given these new technologies and these new social practices, of what a violation of securities laws is? Is it any different now than it was in past cycles?
No, really not. In a lot of ways, you can analyze this as a bubble. It's a micro bubble in the sense that it's limited to a handful of stocks, but it's essentially a bubble. And it's people speculating that the price is going to go up. And, that's obviously very dangerous. But from the SEC's point of view, there are really two ways to pursue it from an enforcement perspective. One is you'd have to look to see if there's manipulation. And manipulation is really a term of art that the Supreme Court defined 40 or 50 years ago. And it really means rigged trades. So in other words, you'd have to have coordinated trading where the back and forth results in no risk to the people who are driving up the price. And at least from what I've seen in the news, there does not yet appear to be evidence of that. The other conventional approach would be to look for misrepresentations or misinformation in the market. So for example, if the person giving the rallying cry here is actually selling a stockpile of stock while telling everybody he's buying the stock, well, that would bring you into a more conventional securities fraud type analysis. But absent either that kind of misrepresentation or evidence of a manipulation, it's a difficult area for the enforcement division to deal with.
Yeah. I'm curious, Andrew, we were talking about it at the top of the show, but an ETF like the SLV, the silver ETF, has a lot more flexibility to issue more shares more quickly when it sees a jump in price, like what we've been seeing today and really in the last couple of days. Standalone stocks don't necessarily have that same ability to issue and sell more shares as quickly. Is that something that the SEC should consider making possible when you do see just the huge spikes that we've seen in names like AMC and GameStop recently? I would imagine that would help with some of the volatility.
Yeah, but you've always got to be careful about issuing emergency orders. Back in the last financial crisis, there was the short selling ban, which was very short-lived because it had very adverse collateral consequences. And so the problem with moving too swiftly is that there are going to be a lot of unintended consequences. And so while proposals along those lines may well be something worth looking at, I think they need to be given both careful consideration, but also opportunities for public comment so that the SEC doesn't inadvertently do more harm than good.
And to that point, this practical matter of the timing of regulation, I think your general view is it takes months and months to get past those public comments, get it into law, or get it in the books in general, and by that point the movement might have passed. Do you think that's a possibility?
It is a possibility, but if there really is a problem in the market, then it's worth looking at to avoid having it occur. On the other hand, these types of bubbles have occurred frequently, certainly during my tenure with the SEC. And, a lot of times the best thing the SEC can do is to get guidance out there for retail investors, making it very, very clear just how risky it is to be buying into this kind of a bubble. And that may be the most effective thing they can do in the short term.
Right. Now, if the investors or traders don't figure that out firsthand, given what prices may or may not do. Andrew, our viewers obviously looking for all kinds of good information regarding regulation, and we appreciate your help on it. Hope to talk to you again. Andrew Calamari.
Thank you very much.
Well, as we head to break, let's get a check on a few big movers in the biotech space, including Novavax, Inovio Pharmaceuticals, and Vir Biotech, all among the leaders of the IBB ETF this morning. Look at those moves. Novavax up another 22%. There's more Squawk on the Street coming up. Stay with us.
What digitization is enabling is innovation, I think, across multiple areas. So if you look at fintech, for example, in India, I think the enabling of the UPI platform has created so much globally. Digitization has got a boost because of the COVID situation. And I think across our customers, we are seeing there's an urgency to transform their models to be more digital.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
One of our primary focuses for 2021 is really to expand our footprint outside of Indonesia. I think, over the last few years, we've definitely invested relatively smaller amounts in our markets outside of Indonesia. But we think this is the year where we really want to spread our wings and be a regional and global business. And food delivery is part of that plan.
Squawk on the Street. I'm Mike Santoli. Stocks are in positive territory this morning, actually building on early gains, though up about 1% in the S&P 500, led by technology and consumer discretionary. But we also did want to take a look at the action unfolding in the materials sector as we continue to watch that silver squeeze that we've all been discussing this morning. Actually lost some of the early gains. The sector was up about 0.5% earlier. McGuire, though, is among the outperformers there, starting the week on a high note. Silver and gold miner, obviously. In fact, FCX, one of the S&P's top gainers over the past 6 months, up more than 100%, and coming off its 10th straight month of gains. David, back to you.
Thank you, Mike. Mike Santoli. Well, after the break, don't miss it. We're going to have an exclusive with the CEO of Charter Communications, Tom Rutledge. We'll be right back.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
Vision for growth. We have vision to be more relevant to our core market. That's why we decided to move our headquarters to Abu Dhabi, support of the Abu Dhabi government and the Abu Dhabi Investment Office. We believe that the Abu Dhabi infrastructure and ecosystem is more suitable for our next new phase of growth and more relevant for the region.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC. Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Charter Communications announced this morning a new $5 billion investment to bring broadband to more than 1 million unserved customer locations. The investment includes $1.2 billion from the Rural Digital Opportunity Fund auction. Joining us now to discuss is Tom Rutledge. He's Charter Communications Chairman and CEO. Tom, always good to have you. Want to get to this expansion of your footprint, but you did report earnings last week, and the stock actually suffered. You've had a great track record of success that nobody can really argue with, but there were concerns about a deceleration in your addition of broadband subscribers. I think down some 27.4%. Still up an astounding 8.3% year over year. But are broadband subscription additions starting to slow, and will that continue, Tom?
No, actually, we forecasted that, obviously 2020 was a very unusual year. And people changed their habits. And we actually had the biggest growth year in our history in 2020 with 2.2 million broadband additions. So it was a significant growth year, and but the growth came in an unusual fashion. A lot of people connected with our rural opportunity, our remote education opportunity fund, and so there were a lot of anomalies in the way the growth occurred. But we actually think growth will continue on its path, kind of like it was the prior year in 2019, an accelerating growth rate that we've had from prior years since we put the company together in 2016. And so we actually expect 2021 to be more similar to what 2019 was, but actually accelerating.
Your revenue number has gone up largely as a result of adding more subscribers, as opposed to, in the case of some of your competitors, raising price.
That's right.
That said, you still raise price a bit. Is it your expectation, though, in 2021, price is going to become a more important component of revenue growth?
No, we've actually generated most of our revenue through subscriber growth, and we believe that's the kind of business model we'd like to run, and we think it's more activity, but we've done some things to make our growth easier, like self-installations. About 80% of our customers now are able to self-install when we do a connection. So we've taken out friction in growth, and we're using growth itself to drive most of our revenue growth.
Tom, you only lost 35,000 video customers last quarter. Are we starting to see the end of people so-called cut the cord, or is that just an anomaly?
Well, we actually grew video for the year last year. I think we're the only company in the country that did so. And the reason we did is because our broadband growth was so good. And the reason our broadband growth was good is because we have great pricing and great packaging and great products. And that broadband growth pulled through a lot of video growth, but the trends in video are still what they were prior to last year, which is multi-channel video growth is slowing because it's expensive. There are alternatives in terms of direct-to-consumer. We still think there's a big opportunity in video, and we're growing smaller packages. We're growing historic packages as well in some cases, and we're providing new products transactionally for customers in an IP format that we think gives us an opportunity to continue to serve customers with a full video product for the foreseeable future.
Another product you're offering, of course, is wireless, which continues to become a larger component overall. 2.4 million subscribers. Obviously, you're not taking on Verizon and AT&T just yet, Tom. But is this going to be a more significant part of your business over time? And did you recently redo your MVNO with Verizon?
We did recently do our MVNO, and we're happy with our relationship with Verizon, and we expect to continue to grow this business, rapidly. In our marketplace, we're the fastest growing mobile provider out there in terms of net adds, and we think that's true for the year last year, and we have great expectations that we can provide mobile connectivity as part of our overall relationship with connectivity through our broadband networks. We actually have 400 million wireless devices connected to our network through Wi-Fi and now mobility. And we just won some CBRS spectrum in an auction, and we'll be able to connect mobile customers through that spectrum as well.
Right. I want to get to, and let's get to it now in the 2 minutes we have left, what I introduced you with, which is the expectation of spending a good deal of money to reach new customers, particularly in rural areas. Tell me a bit about it and why it's important for the company.
It's important because, there are 11 million households in the United States that don't have broadband, and those people are increasingly becoming disconnected from their ability to be part of society and the way society is conducted today. And so, we've worked with the FCC going through an auction to get a subsidy to build out areas that are very low density. And so over the next 7 years, we're going to build out over 1.1 million homes and we're going to bring them connectivity services. We're going to get a subsidy from the FCC, and we're going to contribute private capital and do a massive construction project. If you think about what's involved, Charter today is about 750,000 miles of infrastructure across the country in 41 states. This new construction is going to be about 200,000 miles. That's a lot of physical infrastructure to put up. It's going to require us working with the states, with utility companies to clear poles. The issue in low density subscription is that you have a lot of telephone poles per home as opposed to a lot of homes per pole. Right. And so to do that construction takes time, it takes cooperation, and but we think that it's the right thing to do. We think that we can get good subscriber penetration because people want broadband. And we think that with this subsidy, we can grow the company and we can serve the rural parts of the unserved area today.
Yep, well, it is the key product, as we well know. Tom, got to keep it a little shorter than we typically do, but always appreciate your joining us. Thank you.
Thank you, David.
When we come back, Grammy-nominated rapper Ja Rule, who told GameStop investors last week to, quote, hold the line when Squawk Alley starts in a moment. Dow session high was up 277, currently up just about 60 points.
Is this going to be the presiding factor for the next couple of years or so? Or actually, do you think maybe 2022 it's going to be about the rest of your business?
We see, because of that, a very, very healthy development in Europe and in China. And we will see the United States coming back in the second half. COVID is a boost for modern healthcare, for a more digital healthcare, but in the end also for a more humane way of delivering healthcare.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Good morning. It is 11 a.m. at Clubhouse headquarters in San Francisco. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Happy Monday. Welcome to Squawk Alley. I am John Fort with Carl Quintanilla and Deirdre Bosa. This hour, the Reddit trade continues, but it's more complicated than it looks. We're going to talk about it with former Zillow CEO Spencer Rascoff and Robinhood, payment for order flow, restrictions on trading. What does all this mean for the future of retail investing? We will talk to the former TD Ameritrade CEO, and we're going to talk to longtime Robinhood user Ja Rule. Yes, that Ja Rule, about the cultural impact of this moment, guys. But this twist that we're seeing today with silver and Reddit, and is it Wall Street bets or is it not? It is definitely a wrinkle here, Carl.
You got that right, John. It's actually a big cultural moment, as you said. But first, let's bring in the aforementioned Spencer Rascoff to start off the hour. Of course, Zillow's founder, former CEO, and Palantir board member. Spencer, good to see you again. I guess where to start, right? I mean, I'd love to just get your sense of what you think about market structure and whether or not it's truly changed over the last week or so.
Yeah, look, this is part of a long trend towards the democratization of investing, starting with the early pioneers like E-Trade and Ameritrade that brought stock trading prices down from a couple $100 per trade to 10 to 50. And now Robinhood kind of stands on the shoulders of those giants. But it's not just in that space of stock trading. It's also in online media. I mean, look at what CNBC or Street.com or Yahoo Finance and Motley Fool have done in terms of democratizing access to information about investing. So that long trend is continuing, will continue. I think in the case of Robinhood, and people who use it should know that if you're not paying for the product, you are the product. In that sense, it's like Google and Facebook, which is to say that they're selling your information, and that's their business model. And personally, I'm okay with that, but people that use Robinhood should understand that that's how it works. You know, I think the perspective that I can provide is what it's like to be at a company when it's heavily shorted and when the stock is incredibly volatile. And that is extremely distracting, extremely concerning. You know, it's, I saw Mark Cuban on last week, and I think he said something like, look, in the long run, this all kind of works itself out. Companies too high, companies too low, but in the long run, you know, the stock price is okay. He's right about that over the long term. But employees at the companies, they live in the short term. And when your stock is incredibly volatile, partners get concerned, advertisers get concerned, legitimate shareholders, real long mutual funds and long hedge funds, they get concerned because buried in these short themes, there usually is a little kernel of truth, which the company can rebut. But sometimes these kind of rumors become, they become a narrative of their own. And it's very, very difficult for these companies to fight back.
Right. So extending on that experience you had as a CEO, where you have perhaps a higher than normal short interest, what are they thinking right now, these companies that are seeing those same shorts squeezed? Is there a bit of schadenfreude there? And also, definitely. Spencer, what is the fiduciary role of those CEOs to raise money when their stock is elevated like this?
Yeah, so there's definitely schadenfreude. I mean, look, at Zillow, for example, we knew that we were always one of the most heavily shorted stocks on the NASDAQ. And, you know, that was almost a badge of pride internally. It was like, wow, look at all those unbelievers who think we're going to fail. We're going to prove them wrong. And that's fine. I can sort of accept that. What I can't accept is when hedge funds that are short talk their book and dress it up as research and pretend that it's a research report as if it's sell-side research from a proper investment. Like, it's not. These are hedge funds that are short, and they're talking their book. They're putting out rumors and innuendo, and they're just manipulating the stock prices. And that's very frustrating. And 2012 to 2014 at Zillow, we were the victim of that, and it was a very, very difficult time to be running a company when you have a short attack. Do CEOs and boards have fiduciary to sell stock or to take advantage of market conditions when the stock price is way up? I do think that companies should be opportunistic, and certainly at Zillow we did that many times when we did quick converts or quick equity follow-on offerings when the stock price was pretty elevated, and I think that's just prudent. Now, to try to do it into a really volatile market environment like GameStop is seeing now, or AMC, like, I don't know, that requires pinprick precision, and it's very difficult to pull off.
Right, Spencer, you bring up some good points. It's Deirdre, by the way. Good morning. Throughout this whole saga, it feels like short selling more broadly is getting a bad name. But as you highlight, there can be some benefits in terms of price discovery, pressuring companies to be more efficient. What do you think comes out of this? The way that hedge funds short, or the way that regulators take a look at it? We've heard from some high-profile lawmakers, potentially cracking down on the practice. What is the danger of that if you get rid of short selling?
Yeah, so I'm very ambivalent on this topic. I mean, I understand the value that short selling provides to the market, but I also have trouble with it. But it is true that short sellers sometimes uncover things that are going on at companies, and Enron is the example everyone points to, where short sellers helped uncover accounting fraud, and that's great. But very frequently, short selling also has a dark side, which we've been discussing. And so I think the role that regulators need to take is to try to provide as much information transparency as possible. I think just as CNBC does, for example, when people come on this show, you now disclose whether they hold positions in the companies they're talking about. I don't know if that's regulatory or just CNBC's ethics policy, but that's the type of thing that regulators should be doing. If a hedge fund puts out a so-called research report, they need their position to be disclosed. Now, obviously, it's harder to do that on social media when people are tweeting about stocks. They can't really include their whole disclosure statement, or on Reddit when people are talking about stocks. But the government does need to play a role in evaluating when people or institutions are manipulating stock prices. And they do that. They have done that historically. I mean, stock price manipulation is a real thing that the SEC and other government bodies regulate. They need to continue to do that. And of course, they need budget to do that. These regulators are stretched very, very thin.
Spencer, I wonder if you have a sense yet of what the lesson is from this latest moment that we're in, driven by Reddit. Because when I look at Wall Street Bets this morning, I see a situation where there are a lot of voices on there trying to say, this silver squeeze, it's not us. But I dug into it, and 4 days ago, someone did indeed post in Wall Street Bets about the silver squeeze. The moderators deleted it. Somebody else reposted. There's this big fight now between Wall Street Bets and Wall Street Silver, which is something new that started this weekend because Wall Street Bets didn't want the silver people. I mean, if this is supposed to be democratization, right, are we going to end up with kind of warring factions on Reddit of people we're not sure of their identities but purporting to do research? I just don't know whether we end up in a healthy place and how this gets healthiest for the retail investor. Do you have any thoughts on that yet?
Well, we saw this in early Yahoo Finance message boards. We saw this on Twitter and stock twits. I mean, now, and Reddit's been around for a very, very long time. So it's just sort of having its moment. And of course, it's because GameStop put it in the news. I don't see this going away. I think that retail investors are going to continue to be more and more empowered. They have better access to tools. They have better access to collaboration and coordination with one another. So this is not going away. And I think that's okay. Again, I actually put myself in the camp of the power of the people that these individual investors have long been disempowered. And why should it be that only the hedge funds are able to coordinate and communicate through their Bloomberg terminal, through their idea dinners in the Hamptons, and through their investor conferences in Las Vegas and Midtown Manhattan? I mean, why do the hedge funds get to coordinate and communicate, but the individual investors can't? So I'm in the camp of supporting this overall trend. I do think there's a role for regulators, though, to make sure that people and institutions are not manipulating. And, maybe I'm having my cake and eating it too, but I think it's very hypocritical for hedge funds to say that these individual investors shouldn't be allowed to coordinate and communicate through online message boards. At least they're doing it out in the open. At least they have the courage to talk about these things.
Of course, they should, Spencer. Yes, they should. They should. I completely agree with you on that. But my concern as I look at some of these things that are posted is that the retail investor doesn't know who's posting them. There are allegations that some of these people posting are actually in favor of the hedge funds, and but we don't know what's true. It would be so much more helpful if there were more transparency in who some of these people are who are posting, again, talking their book, which is good, just as long as the retail investor can know who you are.
Well, look, I mean, we've had multiple elections hijacked by government entities in other countries writing things on online message boards, then we don't know who those people are. So we've had even much bigger problems than stock price volatility as a result of the anonymity of online communication. So you're right, it is clearly a problem, but it's not unique to finance. It's also true of political discourse and what we've seen obviously at Facebook and other platforms, Twitter and Twitter bots. I don't know what the solution is, but go ahead, sorry.
No, I was going to say, I mean, your general view that this phenomenon is not going away. Over the weekend, J.P. Morgan argued the exact same thing, and their reasons were all the classics: excessive savings, stimulus, a lack of substitutes where you can spend your cash, and rising home equity, which is something you know a lot about, Spencer.
For sure. And look, we see this in other asset classes too. So, Realty Mogul and Arrived Homes and, Roofstock, they're trying to democratize access to real estate investing. My company, Picasso, is letting people buy portions of second homes. So we're seeing democratization of investing in the equity markets, as we've been discussing, but also in the real estate market. And it is being buoyed by low interest rates and by rising home equity. And just people are flush, or some people are flush and able to invest. And the alternative isn't all that attractive because interest rates are so low. Of course, we've seen this through other big periods of boom, right? The late 90s was the rise of the day trader. And we were at the time, talking about E-Trade and Schwab and Ameritrade and Yahoo Finance and TheStreet.com. And that was everything we were talking about then. And now we're, of course, seeing it again because the stock market's at an all-time high. People have liquidity. And now they have these online discussion boards and even less expensive trading platforms. So in a lot of ways, this isn't all that different than it was in 99 or even in 2005 to 2007. It's just, it goes to 11 this time, as they say. But we've seen this story before.
Yeah, as anyone who was around then can talk a lot about. Spencer, a good discussion to start the hour. We'll see you soon. Spencer Raskoff.
Thank you.
Meantime, guys, the CBO just releasing its annual budget and economic outlook just moments ago. Our Elon Mui has that for us. Elon, over to you.
Well, Deirdre, that the nonpartisan Congressional Budget Office is now projecting that the economy will grow 3.7% this year and average 2.6% over the next 5 years, even without additional fiscal support from Washington. The CBO is also forecasting the unemployment rate would fall to 5.3% this year and that the size of the labor force would return to its pre-pandemic levels by 2022. However, the number of people employed will not return to its previous level until 2024. The CBO estimates that inflation will rise to 2% after 2023 and that the Fed will gradually start to hike interest rates after mid-2024. Now, these economic projections are actually better than what the CBO had forecast last summer. And the CBO says that's because the downturn was not as severe as expected. The first phase of the recovery was sooner and stronger than expected, and because of the last COVID relief package that passed at the end of last year. So, Deirdre, overall, a rosier outlook for the economy over the next 5 years from the CBO. Back to you.
Elon, thank you for bringing that to us. Now, the bull case on Wall Street continues for Tesla this morning. Piper upping the stock to a new street high of, get this, 1,200 today, and defending its thesis in a 100-plus page report. The analysis only on CNBC.com. Tesla shares up 2.7% this morning. Meantime, Ja Rule, the man, he does join us this hour. Don't miss it. We're back in just a moment.
I'm Jemima Versace, and these are the stories you should be checking out on CNBC.com. The social media-fueled trading mania has found another target, silver, sending the spot price and mining stocks soaring. Some Reddit users, meanwhile, are urging retail investors to target ETFs backed by silver bars. That story's on the website now. China could surpass the U.S. as the world's largest economy a few years earlier than was expected due to its rapid recovery from the pandemic. The latest GDP figures show if the yuan strengthens a little bit further, the catch-up could happen as early as 20. Head online for the full story. And Ryanair is forecasting a record full-year net loss of nearly 1 billion euros, adding it is impossible to give guidance for 2022. The low-cost airline warned the pandemic was wreaking havoc on its business after third-quarter revenue fell by 82%. Check out that and more on CNBC.com.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Capital issues, regulatory scrutiny, and an angry online mob all plaguing Robinhood. This week, Kate Rooney has the latest on where things stand for the trading platform. And Kate, it was so interesting to see CEO Vlad Tenev take his media tour to Clubhouse last night.
I know. On Clubhouse, especially with Elon Musk. So we've got more on that. But Robinhood is running into some different issues than your average Silicon Valley disruptor. The biggest one here, the complexity of using Wall Street's back-end trading system. I've talked to a ton of people in the last couple days who tell me this is really a make-or-break moment for Robinhood. The biggest issue they talk about is capital. They need enough capital to run this business. Robinhood said late on Friday night that those requirements from its clearinghouse went up tenfold. They say that's what led them to put those buying restrictions on stocks last week. CEO Vlad Tenev talked to Elon Musk, as you mentioned, on Clubhouse over the weekend. He said that Robinhood needed to post $3 billion in deposits. That formula is a little bit opaque. It's based on what's known as value at risk. It's a lot of money for anyone, but especially for a startup. Robinhood has raised about $2 billion in VC money to date. So Robinhood has to post that money itself because it does clearing and custody in-house versus if you think of SoFi, Square, Webull, some of the other startups sort of do this through a middleman or through a third party. And people I'm talking to say that last week was really a stress test for Robinhood and for all of the other brokerage firms. But those huge capital requirements and some of these new market realities that got us here are not going away. We're seeing this dynamic play out with silver this week. People online are still pouring into those same trades. We've got a post about silver options as one of the top posts in that subreddit, Wall Street Bets. Among the other issues for Robinhood this week, you've got issues from lawmakers in that pushback. We've seen a couple new class action lawsuits over the weekend. And of course, still a lot of noise online about Robinhood. You've got the hashtag delete Robinhood going around. But even as some might be leaving Robinhood, we've got some new estimates out from JMP Securities this morning. It says Robinhood added 600,000 accounts just on Friday alone. So I'm told some of the issues last week were caused by some of this customer growth. So that could be sort of a double-edged sword for Robinhood. Deirdre, back to you.
All right. I will take it. Thank you, Kate. I put your eye on Stitch Fix this morning. Stifel has downgraded that stock to a hold with a price target of $83. That stock, though, up about 60% in the past month. It's up 3x over the past 12 months. A lot more Squawk Alley still ahead. Stay with us.
Get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place.
Our policy here in Jordan, there is no difference between Jordanians and non-Jordanians. We have a lot of agreements with other companies for vaccines, and I think in the next 2 months we'll have a larger number of vaccines available in Jordan, and of course this will give us opportunity to vaccinate more refugees in Jordan.
Were out last week, but today the company unveiling some premium product offerings. Our Phil LeBeau's here with a special guest. Hey, Phil.
Thank you very much, Carl. Let's bring in Robin Hayes, CEO of JetBlue. Robin, how you doing with the storm, first off? And second of all, you guys, reported your Q4 results last week, and we all know the story there for you and the other airlines, another rough quarter, and it's not getting much better. What's your assessment in terms of, particularly with Florida and the Caribbean, the impact and when those markets might start to, benefit you guys a little bit more, given the situation with COVID-19?
Hey, Phil. Great to be on the show again. Snow's doing okay. I think I'm up to about 6 or 7 inches here at the moment. I haven't been outside to count, but look, I mean, we guided Q4 revenue down 67%. We reported Q4 revenue down 67%. We guided quarter one this year 65 to 70% down. So, in other words, we're not really seeing any material improvement. We did see some strength towards the end of last year into some of our Caribbean and Latin America network. But of course, what we've seen since the CDC came out with their international testing requirement last week is we've seen some of that shift actually from international markets into our domestic network.
Do you have a sense how long those markets, the Caribbean markets, will essentially be not completely shut down, but really restricted?
No, I will say I was impressed how quickly many of these markets got testing facilities up and running. A lot of the hotels down there moved quickly to try and make it as easy as I can. And I think word will get out about that. But no, look, I think for a year now, it's been very hard to call what the next few months holds and how things like the progress of vaccines, how case counts come down, how all those things interplay. What I can tell you is JetBlue is ready to react as and when demand wants it.
Robin, if business doesn't pick up by the end of March, do you think that Congress should pass another payroll support program for the airline industry?
Well, I think, look, I'm surprised that we are nearly a year into this and that we haven't really seen any material recovery yet. And if anything, things may get worse again before they get better. What we focus on at JetBlue are what are the steps that we can take to control our own destiny. We came into this with a really strong balance sheet. We've announced over 80 new routes to new leisure markets to try and move airplanes where demand is. And, we're excited about our partnership with American Airlines because that's going to give us the ability to grow much more quickly out of this crisis than we can. So, look, Congress may or may not act, but what we're focused on at JetBlue is making sure we're taking control of our own destiny.
But given the fact that a lot of people are now calling for it within the airline industry, I'm also hearing from people who are saying, again, the airline industry, again, should get another payroll support program. What's your reaction when you hear people say, look, you've had it for a year as an industry, and not everybody's taking the same amount, but after a year, there are some people who are saying enough is enough.
Well, look, I think that what we know is that nearly a year into this, that the travel and hospitality sector has been one of the parts of the economy that has been most impacted. So I think it's right and natural that that is where support should be targeted. We also need to remember that the support that we've been given from the U.S. government, it's about keeping people in jobs. We've all undertaken no furlough commitments. We can't lay anybody off. We've maintained service to communities that otherwise would have lost service. And all of those really mean that all you're doing is paying this support through payroll rather than through unemployment and other forms of costs that the government has underwritten through this pandemic.
Robin, I want to show everybody the renderings of the new Mint seat pods that you guys will be putting on your transatlantic flights. Those are scheduled to start, the flights into London, later this year. Are you still optimistic with the time frame that you've laid out that you'll be able to have these flights with these new gorgeous-looking pods that will be in the Mint first class that people, or business class that people can buy?
Yes, I mean, we're still optimistic. What we are optimistic about is once some of these restrictions come off, things like quarantines, demand will come back very quickly. We have a lot of data that supports that. And we think that there is so much pent-up demand for transatlantic travel, so many families and friends and colleagues and trips that people want to take. But at the moment, it's too difficult because of some of the restrictions that are in place. So whilst I don't have line of sight on when some of those restrictions may start to lift, I am confident when they do, demand will come back very quickly. So that's what we're positioning for, and we're still focused on Q3 this year as our launch date.
Robin Hayes, CEO of JetBlue Airlines, joining us today. Robin, bear with me in terms of the snow. We had it here in Chicago. I know you guys are getting hit on the East Coast right now. You'll get through this and eventually shovel everything out. Deirdre, I'll send it back to you.
Yeah.
Philbo, thank you. One of the chief beneficiaries of the Reddit trade, AMC, getting a downgrade today. MKM takes it to a sell this morning, citing the disconnect between its share price and valuation. However, that call not having an impact on the stock this morning. It's up another nearly 10% right now. And remember, the stock up nearly 600% year to date. We are back in just a moment. Stay with us.
So Julius Baer has reported a 50% rise in full-year net profit. The Swiss bank boosted by robust client trading. Julius Baer also announced a share buyback program of up to 450 million Swiss francs.
We had announced a share buyback which we had to stop due to the COVID pandemic and to regulatory action. We will continue on that path. We are very highly capitalized right now, and we intend to return that excess capital. We do this out of a position of strength.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
I'm Courtney Reagan, and here's your CNBC News update at this hour. One of the worst blizzards to hit the Northeast in years is dumping heavy snow from Pennsylvania to Connecticut. Instead of closing schools, the storm is shutting down vaccination sites and other pandemic-related services. In Chicago, public schools are closed over COVID-19 concerns. Mayor Lori Lightfoot has delayed the start of in-person lessons until tomorrow as talks with the teachers union remain stalled. In Myanmar, the military has staged a coup, detaining the president and senior politicians. Military leaders have declared they will take control of the country for 1 year. Senate Majority Leader Mitch McConnell calls the events in Myanmar, quote, horrifying. And Russia is expanding its crackdown on supporters of opposition leader Alexei Navalny by putting his spokeswoman under house arrest. Over the weekend, more than 5,000 people were reportedly detained in nationwide protest. Deirdre, back over to you.
Courtney Reagan, thank you for that. Brokerages continue to face user backlash over trading restrictions on certain stocks, calling liquidity concerns into question, especially for Robinhood, who continues to operate with limits this morning. Fred Tomczyk joins us now, the former CEO of TD Ameritrade and current CBOE Global Markets board member. Fred, good morning, and thanks for being with us. Now, a lot of focus over the last few days has been on Robinhood's business model, its reliance on payment for order flow to pay for free trades. Yes, other brokerages do this too, like Schwab and TD Ameritrade. However, other trading platforms, startups, SoFi and Square, they do not. So I just wonder, do you think that that makes them a more attractive or at least transparent platform than Robinhood?
No, I don't think so. Payment for order flow has been around for a long time, and it's worked for brokers. It's been very good for brokers and retail investors. In fact, they're getting fast trades and well-executed trades over the years. If you think about it, years ago, you used to execute trades and, it would take, 5 minutes. Today, it takes less than a second. And the market makers and payment for order flow are part of that process and that speed.
Right, but I asked you specifically about Robinhood, which is a startup, not a large brokerage that has been around for many years. The fact that it brought in its in-house clearing a few years ago, at the time it was touted as a way for the company to grow faster, reach further into financial services. But in retrospect, would it have been better off, would its traders have been better off if it had kept its clearinghouse as a third party, especially given the size difference between Robinhood and some of the other brokerages you're talking about?
Well, I don't have any inside knowledge with respect to that. I guess that's a possibility. But the reality is what's causing the problem here, whether it's the broker, a clearing broker or a self-clearing broker in these situations, in my mind, is we're still on T+2, which gives that 2 days of credit risk, which is what causes the capital and the collateral requirements at the clearing houses in the first place. And so whether you clear yourself or whether you clear through a second broker, those kind of requirements are still there and can be put in place at any given time. And I think with technology today, we should all think about whether we should be moving to T+1 or even T+0, and that would eliminate some of this credit risk in the system and avoid this problem.
Fred, what's the best outcome of this moment that we're in for the retail investor, do you think? What gets built or what gets normalized from here that has the biggest positive impact?
I think as you look at this, we've seen situations over my tenure, whether it's the flash crash or anything. I think the most important thing here for retail investors is the playing field between Wall Street and retail continues to get levelized, and that's something that has been going on for 45 years since when Schwab and Ameritrade and E-Trade all started. I think right now what happens here, I think the important thing is that the SEC and people in the industry stand back and do a good analysis of what's going on, what's causing issues here, and do that in a fact-based way and look at the root cause analysis of it. And that's what I'm saying, based on what I've seen and what I've read, T+2, there's no reason we can't move to T+0 over time in the industry, given technology today. And then the second thing, as I stand back and look at all this, social media has a lot of good things about it. And the fact that people can exchange ideas, investing and trading ideas online, I think are good things. However, just like we see in society today, when you're more irreverent and you get more incitement, you can get to extremes that cause problems. And how you deal with that is a broader societal issue. So I think all those two things I think are something to look at. I think the one thing I worry about here.
Well, that's the second part.
Yeah.
The second part is I hope you can focus in on a bit more, because it has to do, I think, with research and good information. I see a lot of ideas floating out there, but then it's unclear where these ideas are coming from, who the real people are behind them, what their reputation is, and then people get accused of having agendas one way or another. Is there a way? Is it important, do you think, for the retail investor to have access to research, to analysis from trusted sources, perhaps at a price or in a model that allows that over time?
I do. And in fact, I think if you went to Ameritrade or E-Trade or Charles Schwab, you would see that they've been providing free research on their websites to their investors for years. They've been educating their investors for years. And so those are good things, and more of that is good. I think you're making a valid point. A lot of those times, those things are done by valid, trusted sources, but they don't always get it right either. And the issue with social media is when you get people that the more irreverent you are, the more followed you get. The more followed you get, the more the algorithms ramp up and you get going. And what you worry about in this situation, and you certainly see it here, is whenever a stock gets untethered to reality, which is what we're seeing right now. I mean, there's no fundamental reason for GameStop to have risen 1,500, 1,700% in 1 month. Then, somebody's going to get hurt at the end of the day. So how you do that is a complicated issue.
Right. And so, Fred, I just wonder very broadly, what do you make of sort of the motives behind the retail investors in bidding up GameStop and AMC and other heavily shorted stocks? What does it tell you about market participation, their role in the markets, the role of short selling, and where do we go from here?
Well, I mean, I think the retail investor has been growing in numbers and influence in the market for a long time. And this is just the next phase of that. And they're becoming a bigger and bigger player. So in these types of situations, you just got to watch. I think you got to be very careful with educate your customers and make sure, people know what they're doing right now here. But, I think the retail trader is here to stay. Social media is here to stay, and learning how to deal with that in these markets, I think, is important.
And sentiment echoed by many other guests on our program this morning. Last question for you. I know you said that payment for order flow has been around forever, but it's under a lot of pressure right now. And there was one trading platform today said that it would actually not use that model and go directly to the exchanges to execute trades, and it's going to rely on a tipping model. I wonder if you think this is just a flash in the pan, or do you think that that business model gets rethought in the weeks ahead?
I think there's people talking about a lot of different things right now, whether it's should we reconsider shorting, should we reconsider payment for order flow? And I continue to come back to the points I made earlier. When I look through all this, we need to look at T+2 to get rid of that credit risk in the system so that nobody has to curb trades. I'll guarantee you, Robinhood, the last thing they wanted to do was curb trades on their customers. They really did not want to do that. And then number two is just look at how social media is being used. What you worry about right now is people doing quasi pump and dump schemes. Are they basically promoting something, making money, and then getting out of the stock and leaving people holding the bag? And so we have to watch for that right now. And I'm sure the SEC, that's one of the things they're watching.
Fred, thanks for being with us today. Fred Tomczyk, former CEO of TD Ameritrade.
In the meantime, guys, watch Viacom and CBS and Discovery. Citi moves to the sidelines on both of those names. Target 46 on Disca, 49 on Viacom, saying the recent rally in both names has been driven in part by short covering. Session highs on the S&P with the VIX below 31. Don't go away.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
China is the most important EV market and will continue to be. So for our market entry in China, we go through a joint venture. Geely and another local government in China will be partners. And we are really happy that Geely decided to come in because Geely is doing more than 2 million cars a year. There's a huge supply chain and economy of scales behind it. And we will bring in our internet technology and our connected car technology.
Helping you navigate the new normal. Squawk Box on CNBC.
how you scale that intimacy. Well, the atomic unit of Clubhouse is a room, and that room is a really flexible container. So we think that if we can empower moderators and other people on the app to host great conversations, you could have millions or billions of people on the platform, but everyone has their own room where they're talking.
That's Paul Davison, the co-founder and CEO of Clubhouse, Silicon Valley's perhaps buzziest startup this week, earlier on Squawk Box. He's talking about the company's premise. It's an audio-only approach to social media, which, by the way, saw an influx of users after Elon Musk hosted his own room and interviewed the CEO of Robinhood. Clubhouse raised a Series B last week, led by Andreessen Horowitz, valuing it just over $1 billion. Watch the full interview on CNBC.com.
Yeah, and John, we haven't had a ton of time over the last few days to talk startups, but you said it, one of the buzziest names out of Silicon Valley over the last few weeks. Now, up next, he's always there when we call. Grammy-nominated rapper and avid Robinhood user, Ja Rule joins us next. By the way, I did not write that tease. Don't go anywhere.
You want to buy my stonks?
I'm good, thank you. But out of curiosity, who else invested in GameStop?
Oh, Ja Rule.
Best of luck to you.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
What digitization is enabling is innovation, I think, across multiple areas. So if you look at fintech, for example, in India, I think the enabling of the UPI platform has created so much globally. Digitization has got a boost because of the COVID situation. And I think across our customers, we are seeing there's an urgency to transform their models to be more digital.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Our next guest is an avid Robinhood user, having been on the platform since 2014, and he's all over Twitter in his criticism of what Robinhood's doing as they continue to impose restrictions on trading certain stocks. Joining us now is Grammy-nominated recording artist Ja Rule. Ja, good morning. Good to have you.
Hey, good morning. How y'all doing? Thanks for having me.
I'm good. So tell me, what's your history with Robinhood? What got you into it? What have you been trading? And are you in any of these, I don't know whether to call it Reddit-driven meme stocks? What do you think?
Well, I got it. I love Robinhood. I love what they represent, you know, putting basically the stock market in your pocket. It's really cool. Let's retail traders trade really quick in real time, and kind of makes you feel like you're on the floor with the traders. So really a cool app. But yeah, I was really upset at what they did the other day because it kind of felt like, everything they stood for, even their name, Robinhood, it kind of all just went in the dumps on what they did the other day by freezing some of the trading on certain stocks, and those stocks happen to be the stocks that were in question, from those guys, with We Bet. Wall Street Bet. So, yeah, so, then shout out to those guys for shaking things up, but my advice would be that for people, whoever's following what's going on, to be very careful. There's have been some people that made money on those stocks, of course, but be very careful. There's been a lot of people that's also lost money on those stocks. So, the stock market is very, very fun place for young millennials. They're on there, shaking things up a little bit, but I would advise people to be careful.
So what would your advice be to Robinhood itself? Because, it was a darling in the social media set for a while, and that now the tide has certainly turned in certain ways based on what happened last week. I mean, you experienced that with Fire Festival, how, people who are all for something can turn against it when things don't go as they expect. What would you tell Robinhood to do here?
Robinhood, you got to let them trade. You got to let people trade, man. You got to, I think the real situation of what's going on is, I don't think the CEO had the money to cover, the actual money that was going through the platform, the margins. I don't think he had enough to cover the margins. So I think that's what's really what the freezing is about. I don't know, but it just looks like, it's playing into the hands of the big Wall Street guys, the big hedge fund guys. That's what it looks like. It's playing, he's playing into their hands, and it's kind of siding with those guys instead of what Robinhood stands for, and letting the little guy trade.
Hey, Ja, a lot of people now wonder what kind of legal risk Robinhood is under, but they do say the terms of service. I understand Robinhood may discontinue my account and any services related to my account immediately with written notice. You think anybody actually read that?
People usually don't read the fine print, and I'm pretty sure what Robinhood did is within the guidelines of what's in that fine print. But nonetheless, people are mad. People are angry. You've heard Elon Musk talk about it. You've heard, Mark Cuban talk about it. Even the AOC talking about it. So it's an issue. It's a problem, and people are mad. People are angry, and they should be. Because this is the app that claims this is about free trade, and they took that power away from people. So.
Ja, it's Deirdre. Good morning. Since you waded into the GameStop fray on Thursday when that stock actually hit its highest level so far, I just wonder, what do you think GameStop will be worth 3 years from now? Is it going to be worth more or less than it's at currently?
It's funny because, the reason why these stocks were being shorted in the first place is because these companies were doing bad. GameStop, AMC, they're brick and mortar stores that are not able to open up because of the pandemic. So, these big hedge fund guys started shorting these companies. So I don't know, where they'll be in the next couple of years. I think the pandemic and stuff like that is gonna, let us know how those companies are gonna survive.
Your tweet was very confident, though, Ja. You said hold the line on a day when GameStop went above $400. So here you're saying your advice is to be careful, but just a few days ago you said hold the line when the stock was above $400.
Listen, here's the thing. Here's the thing. When I was talking about holding the line, that was actually for that day of what was going on. I felt like, this was like a war being waged against the little guy from the hedge fund guys. And these guys, I didn't actually get in on the GameStop stock. I wish I did, because a lot of people got rich on that movement. But like I said, the company is actually not doing well at the moment. So do I think the stock will stay there? I don't think so. But the way the stock was being played with, it felt like if we hold, these guys would have to get on our side of it and buy the stock, to save their money so they don't lose money on the short. That was my thinking of it, not so much of hold it forever and this is going to be a stock that kind of grows in time. No, I wouldn't advise that.
John, that's the part to me of some of this that makes me scratch my chin, is that you can, on the one hand, say, I'm playing for me to win, and then you can, on the other hand, say, I'm playing for the hedge fund or the bank to lose. It gets tricky when you try to have it both ways.
It does.
So
it does.
I wonder. Yeah. I wonder how that's going to get figured out by these traders. But I want to ask you about further your involvement in tech, in apps. You've been a Robinhood user for a while, but you've got interests beyond that. What's the role for somebody with a long-standing brand like you have, a creative mind like you have? What are you working on?
Oh, man, well, right now I'm working on my tech company as we speak. It's called Icon. Shameless plug. Yeah, but it's a live streaming platform that allows content creators to monetize their content. So really, really cool concept. It's growing right now. It's in beta right now. And it's actually doing very well as it's in beta. We've got a lot of early adoption. So cool stuff going on.
All right, best of luck. Ja Rule joining us on these markets, Robinhood, and a little bit
Thanks
more.
For having me, guys. And I see y'all trying to sneak in the Fire Festival on me. It's all good, though. Love you guys.
Hey, we wouldn't be doing our job if we didn't mention. I mean, a social media mob when you see one, man.
Love you guys, man. Much
You're
love to you. Thanks for having me on, man. Hey, listen, I got a great sense of humor. I wish to know me is to love me. Much love, y'all.
Much love.
John, our thanks. That was fantastic. Guys, watch Ford this morning. It's getting a little rip here on the announcement of a 6-year deal with Google that will make the tech giant responsible for much of Ford's in-vehicle connectivity. Outside of the car, Google will help Ford use AI in supply chain logistics and manufacturing. By the way, Alphabet does report tomorrow night. More Squawk Alley after the break.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it, IG it.
We have a vision for growth. We have a vision to be more relevant to our core market. That's why we decided to move our headquarters to Abu Dhabi, support of the Abu Dhabi government and the Abu Dhabi Investment Office. We believe that the Abu Dhabi infrastructure and ecosystem is more suitable for our next new phase of growth and more relevant to the region.
We have spent a lot of time talking about the Reddit trade, or the Reddit rebellion, as some call it. But guys, we do have a big week of earnings. Alphabet, Amazon, Alibaba, all reporting over the next few days at a time, too, when big tech, Amazon even, has been a relative underperformer so far this year.
Yeah, and those unusual trades continue. I'm looking at GoPro up 16%. That stock has not been doing great. We'll see where this week leads, Carl.
Indeed, John, as we keep an eye on the earnings calendar, of course, tomorrow night, Google's up, along with Amazon and Amgen, Electronic Arts and Chipotle. Later in the week, we'll get Qualcomm and eBay and some others. By the way, we do have news from Dow Jones originally that Robinhood has now raised another $2.4 billion from shareholders, citing people familiar. That's $3.4 billion raised since last Thursday, and as Dow Jones points out, that is more than the company has raised in its entire prior existence. Well, watch that. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the new month for stocks, coming amid calls now that a correction has arrived and is likely to get worse. So, does the investment committee agree with that? We debate, we discuss today for the hour with Steve Weiss, Pete Najarian. Courtney Gibson is the president of Loop Capital Markets. Kevin O'Leary, the chairman of O-Shares ETF. Let's go to the wall. Pretty good day on this first day of February. We're green across the board. Dow's good for 230. 0.75%. There's the S&P and the NASDAQ, which is the outperformer today. You can see the NASDAQ's pushing about a 2% gain. You've got some nice moves today in Alphabet, Amazon, Baba, all ahead of those big earnings this week. And that really sets the state of play for us. Guys, you do have this new month for stocks. You do have very big and important earnings this week in tech and elsewhere. We're watching the retail surge impact, volatility in the markets, and what was GameStop is now silver. So we have our eye on that as well. And we do have this call now, Courtney, from Morgan Stanley's Mike Wilson. Quote, the correction has arrived. Positioning and leverage should do the rest. While this correction is likely to get worse and feel bad in the short term, this is not a bubble or like 2000 for many reasons. So calls now that the correction is here. Is it?
Well, good to see you again, Scott. You know, everyone is entitled to an opinion, and I'm sure he's done a ton of research that would say it's here, but I think there are a number of factors that one would say may not allow this correction to last longer than what was Friday. So, you know, when you think about the amount of cash on the sidelines, you look at savings rate, you look at the amount of capital that is going to come into this marketplace with stimulus. You look at, you know, people can say valuations are here, are there. I don't think this market is overvalued. I think this market has finally begun to be discerning. Let's put aside GameStop and AMC and what kind of happened there for just a second. And you look at names that are outperforming in this market. You look at the names that came back when they were beat down last week, and you're actually seeing strong companies come back to the positioning in which they belong. And so I don't think there is a correction right now by any means. You see kind of what's happening with the virus. How long have we been waiting for some good news? How long have we been waiting for the death tolls to pause and the hospitalizations to come down? I mean, I could go on and on. I won't, but, you know, I think there's some good opportunities here.
Yeah, forgive me for interrupting you. I do want to get to Kate Rooney, who has more breaking news on Robinhood, as Carl was just talking about at the end of the prior show. More capital raise. Kate, what can you tell us?
Hey, Scott, Robinhood has raised an additional $2.4 billion. That is on top of $1 billion it raised just last week. So total, in just a few days since last Thursday, Robinhood has brought in $3.4 billion from existing investors. So the names on this list in terms of the backers giving Robinhood some capital here: Ribbit Capital, Iconic, Andreessen Horowitz, Sequoia, Index Ventures, and NEA. All again from existing investors here. And it's in addition to $600 million in credit that they got from their bankers last week. So all of this, of course, to meet those record capital requirements in order to keep these stocks online. And again, $3.4 billion just since last Thursday. Scott, back to you.
All right, Kate Rooney, appreciate that. Thank you very much. Back to our conversation as we were really picking up off the current environment. Yes, Robinhood's a big story within that. And Courtney, you know, we did hear from you. All right, so Kevin O'Leary, maybe a correction's here, maybe it's not. Maybe it's going to get worse, as Mike Wilson said, and maybe it's not. But what I see from you is buying more, and buying a lot more. Buying more Microsoft, buying more Facebook, buying J&J and Apple and Tencent and Baba, which I said reports this week, and Pfizer. That's a lot. What does that say about your view of the market?
I can't find anywhere else to put money that's competitive. I'm not going to put it in fixed income, even though I believe the 10-year will be at 2% by the end of this year, just because of inflationary pressures of whatever stimulus package we get. As far as this correction goes and why I continue to buy, we're in a pause that refreshes, mostly driven by the fact there's some concerns about how fast this virus gets squashed. It doesn't look like it's going to be as easy as we planned. Logistics issues. Now that Biden's fully in control, he owns the issue, and every day we hear the update on where we can get vaccines, where we can't. In addition, there's a big spread in the stimulus package. You know, I love kumbaya politics, and you get it for one day when you hear the inaugural speech, and after that, it's back to business as usual. So we're going to fight about minimum wage, we're going to fight about states, we're going to fight about this, fight about that. In the end, it's not going to be $1.9 trillion. It'll be whatever it is, and then we'll have to look at the stimulus package. But all of that liquidity speaks to owning equities, and you go back to what works. Microsoft's really working. J&J, I want to be in the middle of healthcare. Anything to do with the consumer, I absolutely love. Facebook, it's a gift to get it pulled back of 8%. It's firing in every cylinder. Yes, I know we have to shut it down. It's evil. But you can't do that right now because it's running small business in America, period. Got to wait till we have something else. So that yin and yang's been going on forever. I just see it as a buying opportunity. I'm going to continue with the names that have really served me well and load up to full weightings on them.
Yeah, Pete, I mean, others do too. Even if you think that there's going to be more, deleveraging or de-risking from hedge funds, which may go on for, some period of time. Mike Novogratz tweets today, I'll read this because it's important. I think it really represents the view that's widely out there. Most people I know, he says, in the equity markets are waiting to buy as soon as they think the deleveraging is over. The macro backdrop is still stocks higher, assets higher, tons of cash around, and an economy that will explode in a good way once enough of us get jabbed. Speaking of the vaccine, that seems to be the prevailing view, Pete, that even if you think stocks may be in a period of turbulence or heightened volatility and they do pull back, there's a lot of buyers waiting to pounce in this market.
Yeah, I totally agree with that. As a matter of fact, I'd be one of those. I haven't trimmed back as much as I'd like to, Scott, and the only way I've been able to is I look at these names, and to Kevin's point, I look at a lot of these names. I like these names. I like where they're trading right now for the most part, so that's why I continue to hold on to them. And I've talked about, hey, I'm going to start trimming some of these equities. I trimmed a couple, Scott, but almost nothing. And so I think that the reality has been for me, how do I do this in a way that still makes some sense? I could take advantage of volatility. So when we talk about the VIX all the time, you look at those implied volatilities within the VIX. So the VIX was just trading in the 22s not that terribly long ago. Yesterday we were 33. This morning we were 33. That gives you an opportunity to use that volatility that has come back into the market and the implied volatilities of most of the stocks that I'm trading right now. It gives me a chance to sell right on top. So in other words, if normally in Apple I would sell about a 10% out of the money call a month out, let's just say, I'm not doing that. I am selling options against my long stock positions that are right on top of where we are. Now, that's going to make it a lot more difficult if we go straight up, but it also gives me a lot more cushion to the downside, and I'm taking advantage of the implied volatility in a lot of these various names that has risen by 5, 10, 15, 20%.
Who knows if we go straight up or not, right? Weiss, I'm curious for your perspective, not only on the Mike Wilson commentary today, again, saying that, if you're waiting a correction, don't wait because it's already here. And it's likely to get painful, at least feel bad. But there's no reason to think that you're in sort of bigger moment that's going to have a 2000-like upset, even as others are talking about some similarities that are to the year 2000 and that period, whether it's the heightened retail involvement or what have you. You do, as David Kostin says, have the biggest short squeeze in some 25 years. What's your view on where we are now as you hear from some of your colleagues on our committee today who are buying stocks?
Well, I've also increased exposure, but I've done it a little differently. I did it through some bull spreads on names that I own, like Qualcomm and Qorvo. So I'm very positive on the market. I think it's an okay conversation to have, what Mike Wilson's saying, although I remember when strategists used to take the long view instead of trying to day trade the market. But I think you got to put that noise aside. You got to put the noise aside of Reddit. We're talking about isolated instances. We're not talking about a reckoning in the market. We're not talking about democratization of retail into the market as if it's just happening. John Bogle started that with Vanguard years ago. So we're seeing the trend continue, yes. But I agree with Mike Novogratz. What we're going to see is the fastest growing economy that we've seen in years and years. And the deleveraging has already happened. The degrossing has happened. We saw the biggest grossing in the quickest time in hedge funds since 2010. The level of degrossing is rivaling what happened in March of last year when COVID first hit and the panic ensued. So that, if you're waiting for that, don't wait for the bottom. You can't call the bottom of it. Now's the time to put your money in. But what you've got massive stimulus, whether it's a $1,000 check or a $1,400 check, whether it's an infrastructure bill that's $4 trillion or $1 trillion, you're going to see it all the time. As Jay Powell made clear, you have free money. So we're seeing some great earnings reports, particularly from technology. So I'm not surprised technology's up today. I was surprised it was down as much as it was last week, and it was a painful week for me, despite having some big winners there, like a Skyworks. Skyworks sells at a big discount to the market, so there's value there. Not everything is so overvalued. So my advice is ignore the noise, ignore the short-term maturations in the market. We just don't know what's happening there. You can't pick them, and just focus on the long ball and a burgeoning economy that's going to explode.
Sure, but I've been wondering too, and just to push back a little bit, no one is suggesting that this is the birth of the retail investor. As you say, Jack Bogle and Vanguard and others obviously pioneering what retail investors have been able to do for decades and decades. But this feels, and I think certainly is, without question, a renaissance of the retail investor. I explore that through you, who, by the way, is more sophisticated and with it than people have given them credit for, perhaps over the last many years. One of my questions is the fact that they're so engaged in a market that has been so hot since the March lows. Does that put a little bit of a floor under the market? So even if you say, okay, a correction may be here and it may be worse than you think, and that's one person's call, you do have a cohort, and a rather large one, that is engaged and involved in buying stocks like they haven't done in years. Steve, what's the broad implication of that for the market itself? And Courtney, you after Steve.
And
Steve, just finish your thought. Since it was your thought, I come back to you.
Right. I agree with that. I think we've seen a lot of it, but it hasn't been in the headlines. For example, in Apple. You've seen so much retail buying in Apple and other names. So yes, you have another investor class that's coming in on the margin. Additional buyers are very, very positive. But in my view, they're also weak-handed. So, the sword, it cuts both ways. Right now, we're benefiting from it. We may not benefit from it if the market hits a rough spot. But clearly, having, as I said, that marginal buyer is a positive for the market, but in a limited group of stocks. And I wouldn't give them more credit and say that they're all sophisticated. A lot of them aren't. Some are. As a matter of fact, the person who started this whole thing with GameStop was looking for a value play. He wasn't looking for a short squeeze. That happened after.
No,
so
but of course, come on. I get it. I get it. But hedge funds have blown up too by making stupid bets on the wrong side too. I mean, regardless of the size of your wallet, everybody's made dumb moves in the market over a period of time. I think that's an important point to make out. We're learning that over the last couple of weeks. People make dumb bets. Whether you have all the money in the world or not that much money, if you're engaged in the market, chances are over a period of time, you're going to be on the wrong side of a trade or two. Courtney, go ahead.
And Scott, I will tell you unequivocally, I am more excited than I've ever been at the engagement around this market. You may not like the fact that we have new traders in the market that aren't investors the way they've seen forever ago. That's okay. But when you tell me, and I saw these statistics today and I was shocked, that last year, credit card debt, when everyone was all fearful of the retail investor, the consumer doing so poorly and they aren't going to know what they're going to do with their money, they're going to run their credit cards up. Credit card debt went down 10% last year. $4 trillion injected in savings accounts, $5 trillion in savings. Okay? Those are numbers that are real. And what it says to me is, yes, you have capital flowing in from retail investors. I do not believe, some of them, yes, are not as astute as maybe one might want them to be ultimately. But you know what? There's a lot of capital out there coming into these markets potentially that is a good thing. There's a lot of capital on the sidelines waiting to go into that 2/3 of GDP, i.e. the consumer, that's going to help rev this economy back. I'm okay with that. We need more education. We need more things kind of around the edges and the frills. But this engagement, Scott, is something that we should all welcome and welcome with open arms.
Okay. The question is, where's this money going to go? Where is this new money, whether it's the Novogratz type money that he's referencing, you know, people he knows who are waiting for some kind of, you know, for the end of this deleveraging period and money goes in, or if it's retail or what have you, Kevin. We got tech in focus, okay? Earnings this week: Alphabet, Amazon, Qualcomm, NXP, PayPal, eBay, and Qorvo. Let's also not forget that Apple and Facebook did not trade all that well after their earnings, and I get that they had big moves into the print, but nonetheless, the earnings, Apple's on January 27th, the stock is down 7%. That gives you an idea. So where's the bar for these other names, Kevin? The Alphabets, the Amazons, the Qualcomms, you know, and maybe some of the others too. You own Amazon.
I do own Amazon. And, you know, sometimes you trade down before the print, and sometimes you trade down after the print. In the case of Facebook, there was nothing wrong with the Facebook numbers. They blew their numbers away, and it just showed the continued momentum. I wanted to make reference, though, to the extra $2 billion that was just raised in the last hour for Robinhood, and point something out in terms of all of us as investors. You know, there was millions of people. There's 100 million people who don't have any investment account for retirement in America. That's still a problem. That's because of the lack of education that Courtney referenced. So you don't teach it in high school. Along comes Vlad and his team over at Robinhood, picks up 16 million accounts. Now, whether you like the way they trade or they don't, they affect the markets for the first time. So the little guy has power. For this weekend, I've never seen anything like this, because I try and monitor social media versus what I own. Is anybody starting to track or saying anything out there on any big position I have? And this weekend on Instagram, I have an account there, Kevin O'Leary TV. It exploded with this whole vibe of sticking it to the big man. And I'm thinking to myself, yikes, what am I short right now? And I'm not the only guy thinking that. Who ever worried about 25-year-olds taking you out behind the barn and shooting you? That's basically what the market has to deal with now. I don't care if it's silver or if it's GameStop or AMC. That's a new product out there, Scott.
No, you make a good point, and there's a lot of commentary out there today, including on Twitter, that in general, if nothing else, this is going to change the hedge fund risk model. They're going to have to sort of rethink the way they're engaged in the market, and also the way that they're publicly engaged in the market, and the way they talk about different positions that they have. But Weiss, you're right in the center of the mix this week. You own Alphabet, you've got Qualcomm, you've got Amazon, you've got Qorvo, and you've made some moves, I believe, around Qorvo too. So just give us your sort of lay of the land in big tech. Are these stocks at risk of doing what Apple and Facebook did and trading lower on the print, a sell on the news, so to speak?
You know, I don't think so, because, as I said, I put a bull spread on Qorvo and Qualcomm, which means that I'm betting on it to go up, in addition to my equity positions. We look at Skyworks. Skyworks was moving nicely, although it came down right before the quarter, market-related, not stock-related, and look at it on Friday. Look at it today. So you've had a huge move there. We take a look at Netflix. Netflix didn't trade up into the quarter, and it's come down with the NASDAQ market, but it exploded on the quarter. Then there's Teradyne, and Teradyne was down about 17% after the quarter, despite good numbers. So it's really very stock-specific, and that's why I don't think it'll affect the overall market. But as far as, you know, the hedge fund model, look, hedge funds don't go into, in my view, except for maybe a Chanos who's just a pure short seller, they don't expect to make money on shorts. Those are hedges. And whether they hedge with ETFs, with other, you know, products, or whether they hedge with short stocks, they're going to lose money. That's been the pattern. It's hurt their performance, but allows them to collect 2 and 20 or whatever, because you don't get paid that for being long. If you want to be a long manager, you get money, you earn a VIG, an incentive over and above what the S&P does, or some sort of hurdle. So that's why they keep the market. I don't remember looking at hedge funds too many that have made money over the last 10 years consistently in the short side, except for certain periods of time, like in last March. I'm happy with my positions. I'm not doing anything with them.
Okay, I want to stay on the conversation of the stocks that are reporting, right? Wapner's rule of thumb. Train moves on, train doesn't turn back, okay? Courtney, okay? You got that? Train moves on, train doesn't go back. Courtney, and if you miss it, you miss the train. You got to get the next one. Courtney, PayPal reports this week, recent purchase of yours, and you've been adding more. Talk to me.
Look, Scott, I have loved financials and tech. You put them together, you got fintech, right? You got this payment system. I'm a very, very big proponent, as you know, of Square. I've talked about PayPal forever. The biggest winner of the Robinhood transfer, which I don't think will last very long, is going to be Square and Cash App, right? Every millennial has Cash App on their phone, and so do their parents and grandparents to send us money, right? So ultimately, that's one. And PayPal's Venmo, you know, I'm going to not talk about the tremendous benefits of the stock, because you guys can all do the research and you know the business model. Go into a nail shop, go into a restaurant, go anywhere, and yes, you can go right now safely in certain states that are open. You can pay with Venmo. I leave my wallet at home sometimes and just pay with my phone. How often? Look at what that does. Look at what digital payments does. They brought in 70 million new users, right, last year alone on a base of, I think, over 300 million, according to our analyst at Loop Capital, Ken Hill. This is our #1 pick of 2021. And I got in late. I wish I'd gotten in sooner, but I've been picking up. Absolutely. I got in late. My girl Bryn, she told me to buy it at somewhere well below 200. I got in when it dipped below 230 last week, Scott, and I just picked up tons of it, and I think it goes well above 300. We have a 274 price target on it right now.
Okay, I hope you make money in that. Pete, you previously owned PayPal.
I will.
You don't own it now.
I did.
But we do have a big week for those earnings. You don't seem to have much play within them, but I'm guessing you have some pretty big thoughts about these big names and the impact maybe it could have on some of the ones you are invested or at least trading in through the options market.
Right, absolutely, Scott. So when you look back, obviously we've had multiple different weeks now of some incredible, some of the largest market cap companies delivering their earnings. And I think you can read some of what we came with from last week. For instance, with a Microsoft looking at Amazon, because let's be honest, Amazon, it's about AWS. That is Amazon to me. So as I look at this coming quarter, I have to think that they've been killing it. We know what happened with Microsoft. They ran into the number. Stock was 240, pulled back, and then once again, it bounced right back up towards these levels once again. So I think that would be bullish for Amazon. I think Amazon's going to have a solid report. And when they do, I think that's actually going to be bullish as well for Microsoft. They're in the right spot. They're in the cloud. So as we look ahead, I'm not in a lot of these various names. I loved PayPal. I was in it way too early because I got out way too early. I got out, I think, back around 160. So this is up in the stratosphere for me, and I'm amazed that it continues to go to the upside, but all of the factors of why it was a great company going in still do exist. Obviously, the purchase of Venmo was unbelievable. Courtney diagnosed that very, very well, and I think it's a stock that could easily go a lot higher. I just don't have the patience right now to be able to jump into it, because I feel like when I do look at the multiple here now, it's a little bit more difficult for me. I get it, though. I totally understand why it could continue to go to the upside. I just am missing that ride. I'm just riding other trains right now.
Intraday, liking the conversation for sure. I mean, the stock is up. Highs of the day for PayPal, nearly 4%. You are, Pete, involved in Twitter, which, by the way, was named the top pick at JP Morgan today. They go overweight, or they reiterate it more likely. Their price target is $65. There was obviously a lot of talk about social media stocks, and Twitter among them, in the moves that they made with former President Trump and some others. And JP Morgan acknowledges that. We recognize investor concerns around engagement in a post-Trump world, though we believe a small number of users were only on the platform to follow Mr. Trump. Talk to me about your Twitter play here. 1 month, it's down 4%. Yeah. 3 months, it's up 25.5%, Pete.
Yeah, this is a name that I've owned for quite a few months, and part of the reason I owned it, Scott, was going into the elections. And that was like 3-4 months even going into those elections that I felt like, you know, the atmosphere that we are in right now at that point in time was going to be favorable for some of the social media, specifically, I think, because of the engagement levels with Twitter. And obviously, I love Instagram because of Facebook. I own Facebook stock as well. But I do think that they are, even though they get compared to each other oftentimes, I think Twitter's its own animal. And I think that they're in a very sweet spot right now. And like JP Morgan is diagnosed on this whole thing, too, I think that there's a lot more to Twitter going forward. It was not just a Trump trade. I think there's far more to it. As a matter of fact, from a financial aspect, it's a great resource, and I use it frequently to reach out and find out some of the news. I mean, there's a lot of different mechanisms that we can all use through Twitter. It's not just about some silliness. There's a lot of different things that I think there are some good factual things that we can all dig out if we want to. And there is the social side. But I think this is a stock. I've owned it for a long period of time now, probably 6-7 months, and I think I could continue to own this for quite a long time unless they stumble. And so far, Jack has done a great job, I think. Even after all of the situations, he didn't feel the pain when it came to some of the decisions that they made about the president and others that they decided that they were going to restrict. So because of that, they were able to get through that. I think the stock goes higher.
You got that highs of the day on Twitter as well. That's 3 3/4%. That brings me now to a battle. We like to have battles and debates on this show. ExxonMobil, okay? Added to JP Morgan's focus list. There were those reports that Exxon and Chevron, by the way, had discussed a deal in 2020. They go overweight. The price target is $56. Courtney, you own Exxon. Tell me about why you own this stock. I'm somewhat surprised that you own ExxonMobil. And then I want Kevin to give sort of the other side of that from a self-professed energy stock hater. Courtney, you're first.
Ooh. Well, no, absolutely, Scott. So, you know, I don't like certain things about the company. However, if you actually want to affect change, getting out of it is not the way to do it. When you look at what large institutional investors are doing, when you look at what large asset owners, i.e. the CalPERS, CalSTRS, I think Chris Ailman most recently talked about the fact that he's not going to divest of his position. Why? He's much more effective going in there and saying, guys, let's change how you're doing this in order to impact change. As we've talked about before, this generation, right, whether you're talking about millennials, Gen Zs, you name it, wants to actually have a world to live in. So clearly when you think about going into an energy company, you want to go into the best, and you want to go into companies that actually have the propensity to potentially change. They can't change their full model, but there are ways to change what they do to have less of a carbon footprint in our world, and I think Exxon is well positioned to do that. And there are owners that have to hold these. Certain index funds have to hold the positions. You can go into customized portfolios, but if you're the city of Birmingham's pension system, they don't have the ability to customize right now. So when you think about people that have to be in the name, it's an opportunity, and it's an even bigger opportunity for the $7-8 trillion asset manager like a BlackRock and Larry Fink to come in and say, let's really look at this model and how can we change it to be more beneficial for our future.
Okay. I put your position out there, Kev, the guy who doesn't like energy. I'm going to take a break, if you'll beg my pardon on that, please. Straight ahead, a trailblazer in the electronic trading space, Kyle Zaske gives us his thoughts on the retail trading revolution, much more when we're back on The Half in 2 minutes.
Resilience is now on the CEO agenda of every company across all industries. 90% of all supply chain leaders now say that they have to change their approach in order to make it more resilient.
The word resilience is fundamental to the mission of Danone. Without the resilience of a food system, there is no human species. It's as simple as that.
When you have a more resilient supply chain, it makes for better availability and resilience and flexibility in the future.
Is this going to be the presiding factor for the next couple of years or so? Or actually, do you think maybe 2022 it's going to be about the rest of your business?
We see, because of that, a very, very healthy development in Europe and in China. We will see the United States coming back in the second half. COVID is a boost for modern healthcare, for a more digital healthcare, but in the end also for a more humane way of delivering healthcare.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Courtney Reagan, and here's your CNBC News update at this hour. A congressional panel says it is investigating 3 large meatpacking companies for worker safety violations connected to COVID-19 outbreaks at their facilities that reportedly killed hundreds of workers. The firms are JBS USA, Tyson Foods, and Smithfield Foods. On the first day of Black History Month, the American Civil Liberties Union has announced it has elected its first black president ever. Deborah Archer will be just the 8th president in the organization's 101-year history. Currently, she's a professor at NYU Law School. And at the International Space Station, 2 NASA astronauts are finishing up 4 years of power upgrades to the spacecraft. They're also installing a pair of new cameras. Their work is expected to last 6.5 hours. Back over to you, Scott.
All right, Court, appreciate it. Thank you very much. The reemergence of the retail investor has been made possible by the lightning-fast way stocks can be traded today from just about anywhere. Our next guest is considered a pioneer in the electronic trading space. Kyle Zasky co-founded Edge Trade. He sold it to Knight in 2008, now a partner at the investment firm Senna Hill. Welcome. It's good to see you again.
Good to see you. Happy to be back on.
Yeah, you know, you 20 years ago when we first met were at that time really shaking up the landscape for the retail investor then. Now we're in the midst of what I truly believe is a renaissance. What do you think about as you're watching all of this unfold?
Yeah, look, it's exciting to watch. I know there's a lot of vested interest here and a lot of hyperbole, and I think the net opinion that I have is, number one, it's very good for more participants to be in the market than less. I think sort of like the on-ramp to participation and sort of all the talk about Robinhood in particular and whether that's good or bad. I think what may be lost in the conversation, and this is where my work at Senna Hill is a lot more relevant, is there's been enormous progress the last 5, 6, 7 years in terms of engaging with retail investors through financial technology. There are a lot of apps, savings apps, investing apps out there that are not specifically about encouraging day trading, if you will. I know that's sort of my pedigree and my past from the 90s. But when I think about the companies that are out there right now, you could be 18, 19, 20 years old. You could start investing with $5 or $10 or $20 through companies like Stash Invest and Acorns, companies that really try to encourage disciplined, regular investing and dollar cost averaging and investing in themes and ETFs that are important to you. And that kind of inclusion is extremely important for capitalism. And when I think about this, and I'll pause in a second so I don't just keep talking in a run-on sentence here, I think what's most important, this kind of topic of sort of the wealth inequality in this country and the impact that it has on our country and on the world. One practical way to help tackle that is to have more inclusion in financial markets. Let's make our society an ownership society rather than just, the 1% or 5% being engaged in markets. So I think, that kind of forest from the trees kind of gets lost when we think about what's happened in the last week with the short squeeze, but there's so much good stuff happening, and I think it gets lost in the conversation.
I'm glad you make that point. And I mean, the fact is, and you allude to this as well, it's just never been easier or cheaper for the regular person trader to get involved in the stock market. It's really as simple as Ja Rule put it within the last hour. Robinhood, in his words, put the stock market in your pocket. That has literally been what's happened. It has opened it up to an entirely new universe of people.
That's correct. But I think we do need to parse, because I know there's a lot of conversation about, should we be doing more to protect these individuals from themselves? Should we stop them from trading? I think that kind of rhetoric has to go away. I think people should be allowed to speculate if they want. They should be allowed to buy stocks and sell it a few moments later for a profit. They can have any sort of perspective they want to participate. I just don't think that necessarily Robinhood should be the top of mind as the only mechanism, that they're the trailblazer that did something like this. I think encouraging people to invest for the first time is probably more important than encouraging people to trade for the first time. And look, I made my money starting a day trading company, so I don't want to sort of, be the hypocrite here. But from a day trading perspective, I think statistics show it's really for the most part, a losing proposition for most people. And I think the conversation should really evolve more to how do you create better habits for participating in the markets? And that's not really through Robinhood. That's through a lot of different apps and saving apps and financial management systems out there that are really helping anyone for as little as $5 or $10 to start participating and learning. It's fantastic. Somebody used the word renaissance. It's been happening for probably like the last 7 or 8 years, and we've had tens of millions of new accounts at these kind of companies. It's fantastic.
Yep. Yeah, here. Steve Weiss and Kevin O'Leary would like to ask you a question, Kyle. Steve, why don't you go first, and then Mr. Wonderful, you can follow Steve, please.
Yeah, Kyle, I agree with basically everything you said, but here's the question. Do you think that having these Robinhood traders in, the day traders, how long do you think that can go on, number one? And number two, having this whole new class of investors coming in, is that going to increase volatility in the market or not meaningfully?
Yes, so let me answer the second part of that first. Probably will increase volatility, and we've seen some examples of it when we sort of have this flash mob into particular names. But the net effect of it, whether it lasts or it doesn't last, you guys are all markets folk. The more participants from different areas, be it institutional, which are asset managers or hedge funds, to retail investors that are buying and holding, to traders with different time horizons, the more people in that marketplace at the same time, net for net, results probably in better pricing transparency, better execution, and all around healthier market. And the volatility, if it creates it in the short term, that doesn't mean we should sort of think, let's remove a certain portion of those participants because we think it's going to smooth out volatility. So I don't remember what the first part of the question was. If you repeat it, I'll try to address that as well.
Let me ask you a question.
Let me do this. Let me get. I don't have too much time. I don't have a ton of time. Let me get Kevin O'Leary involved. Kev, what do you have for Kyle?
Kyle, quick question about Robinhood. We know that Schwab changed the whole model when they went to zero commissions, but they have lots of other products to sell you, from money markets to mutual funds. You don't have that over at Robinhood. The big scrutiny on this platform has been how do they make their money in the Citadel situation. Do you have any problem with that?
Yeah, actually, it's almost like a layup for me, Kevin. I mean, look, I spent the better part of the 90s focusing on best execution, agency-only trading. Payment for order flow was something that was sinister in my mind. And I always told people who wanted to trade semi-professionally or professionally should have direct market access. So I was kind of like the anti-payment for order flow. But over the decades, and we're talking now about, not a handful of traders doing professionally, but for millions of people who use Robinhood, and then Robinhood makes that money by sending it to a market maker, and which results in a sort of a free commission, which is a marketing tool, and they make their money behind the scenes. I think there's a place for those electronic market makers that actually enable not necessarily just Robinhood, but all those broker dealers that cater to retail to actually have be able to help somebody buy 50 shares or a fraction of a stock. So it's not about payment for order flow versus direct market access. But to your point, I think if you want to help people, institutional or retail, having access to more than just being able to short-term trade stocks in and out, access to ETFs, access to educational tools, access to alternatives, things that are not publicly traded. These are big themes. There's a lot of going on in the crowdfunding space. Why should only accredited investors be able to invest in startups? There's regulation coming down the pike related to that. So I think, from a justice perspective and an access perspective, maybe to kind of reduce some of the anger and finger pointing that you hear on Twitter about, take down the big guy, is people should have access to different financial products through different service providers. And I think we're going in the right direction. That's kind of my point, not pointing a finger and saying, why don't people have access? We are going in the right direction, and the way to kind of counter the rhetoric going on is not to put ourselves on the back feet. I'm part of the establishment now, funny enough. I used to be a rebel. I think we're doing great things, and that should be the voice to maybe educate some of the younger audiences who didn't live through that. They've kind of just woke up 5 years ago, used to buying and selling on their phone, and they think that's the way it is. And nobody's ever done anything to help them. But the truth is the markets, venture capital, even traditional established players, I think we're doing a really, really good job, and it's getting lost, and we're kind of being attacked right now.
We'll call you a rebel with a cause. I love this conversation. I feel like we're all smarter from listening to you speak about the markets from somebody who knows them. It's so relevant to what we're witnessing now. It really is good to see you again. We'll do this again. Kyle Zasky, thanks so much.
Appreciate it. Thanks, guys.
All right, up next, the big ETFs to watch today as we go to break. A check on the S&P sectors today. Got a pretty good market session underway now. You notice the NASDAQ up 2 1/3%. S&P's highs of the day as well. That's better than 1.5% as well, up almost 57 points. We're back right after this.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
Financially, I believe everybody is in a very challenging positions and situations. We do have restructure some or most of our debts. We communicate and negotiate with our lessors already. But we are pretty much confident with the support of Indonesian government in making sure that moving forward, we can achieve what we are aiming, which is 50% of our target revenue compared to 2019.
Welcome to the ETF Edge portion of halftime. I'm Bob Pisani. Silver and silver ETFs moving today. Could a short squeeze really work in silver? Let's ask Will Rhind. He's the founder and CEO of Granite Shares ETF. They run the Granite Shares Commodity ETF, the symbol COMB, that owns silver. He also runs a gold and a platinum ETF. Will, is silver really heavily shorted? And would it be possible for the Reddit crowd to move silver like it moved GameStop?
Well, certainly silver and other commodities are shorted, so there's no debate about that. I think, though, the difference here is that you have a lot of commercial interests in the short market. So you have legitimate interests, banks maybe selling to or hedging on behalf of mining customers, or selling to refiners. So there's a lot of stuff that can get mixed up in the data. But long story short, I don't think what happened in GameStop will happen to something like silver. One, because silver is just a much, much bigger market than what we saw pre the GameStop mania. And two, you can put more supply onto the market, be either in the professional market via futures, or also physical supply via recycling coming back into the market at higher prices.
Yeah, and what about the regulators? The CFTC, the Commodity Futures Trading Commission, regulates commodity futures like silver. They routinely step in to raise and lower margin requirements when there is sudden movements. They did it back in August. If this keeps up, will the CFTC actually step in?
Yeah, so the margin requirements, Bob, are set by the exchanges, and this is primary to avoid counterparty risk and limit volatility in the market. And obviously, big blow-ups like MF Global that happened a few years ago, we don't want that to happen again. And so from an exchange perspective, want to make sure that the market is operating normally. And if there's a heightened case of volatility, the exchange can raise margin requirements and force market participants to post higher amounts of collateral against those positions.
Okay, thanks, Will. Appreciate that. There's much more on silver and on ETFs when Will rejoins us for ETF Edge. That's at 1:05 p.m. Eastern Time today. Also on ETF Edge, Dan Egan, the Managing Director of Behavioral Finance and Investing at Betterment. He talks about the Reddit crowd and behavioral finance lessons. He's joined by Todd Rosenbluth from CFRA. ETFEdge.cnbc.com. Halftime. Back right after this.
So Julius Baer has reported a 50% rise in full-year net profit, the Swiss bank boosted by robust client trading. Julius Baer also announced a share buyback program of up to 450 million Swiss francs.
We had announced a share buyback which we had to stop due to the COVID pandemic and to regulatory action. We will continue on that path. We are very highly capitalized right now, and we intend to return that excess capital. We do this out of a position of strength.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
It's that time again. Pete Nigerian, unusual activity. What do you got for us?
I'm going to start off with SUM, Summit Materials, Scott. That's construction materials. Really aggressive buying in there. The March 20 calls. The stock was trading right around 21. They were buying the March 20 calls. They bought 7,500 of those. You also see a trade of the March 22.5 calls. 7,500 of those. Those were both bought. That's not a spread. So we call that a call stupid because they're buying and buying, which means you're putting yourself into a bind. The stock's got to go higher. It's already on the move as we speak. DXC Technologies is my second one, and that one's pretty aggressive buying as well. 10,000 of the March 30 calls getting bought for about $1.50. I liked both of these. They're both going out to March. They give me plenty of time, so I'm in both these calls in both DXC as well as SUM.
All right, good stuff, Pete. Thank you for that. The snow is falling. Nat gas prices, though, they are spiking. We have more on that big move coming up next. And do you have a money dispute? Kevin O'Leary wants to hear all sides and help you determine the best way forward. Go to cnbc.com/money dispute. Tell him your story. See if Mr. Wonderful can help you out. We're casting now. Halftime's back after this.
Let me show you something.
What is this?
Every time we bought timber, I paid a little extra to regrow trees with my own money.
But why?
Why do you think?
China is the most important EV market and will continue to be. So for our market entry in China, we go through a joint venture. Geely and another local government in China will be partners. And we are really happy that Geely decided to come in, because Geely is doing more than 2 million cars a year. There's a huge supply chain and economy of scales behind it. And we will bring in our internet technology and our connected car technology.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
Let's do the futures outlook now. Natural gas surging today, double digits. Let's bring in Scott Nations for more. Scott, I guess it's no surprise, right? The temperatures are plummeting, snow's falling, nat gas is rising.
That's right, Scott. I mean, it's the first week in February. It's what you would expect. But the interesting thing is this is a little under the radar. I mean, nat gas is up half again. What silver is up. And while it's up double digits, you know, there's plenty of supply. We see more supply right now than we had this time last year. There's more than the 5-year average for this time of year. So we really shouldn't be worried. I would actually be a seller. I would take the opportunity to sell this if I could stop into the trade. So I would sell the March contract, $2.75. Again, that's when it's coming back down. That'd be the March contract. Target $2.40. My stop, we're always going to trade these with a stop, $2.95. At those prices, Scott, we're risking $2,000 to make $3,500.
All right, thanks for that trade. Scott, we'll talk to you soon. Scott Nations. We'll take a quick break. We'll come back. We'll do final trades straight ahead.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
What digitization is enabling is innovation, I think, across multiple areas. So if you look at fintech, for example, in India, I think the enabling of the UPI platform has created so much globally. Digitization has got a boost because of the COVID situation, and I think across our customers we are seeing there's an urgency to transform their models to be more digital.
Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch on CNBC.
That's why we decided to move our headquarters to Abu Dhabi, support of the Abu Dhabi government and the Abu Dhabi Investment Office. We believe that the Abu Dhabi infrastructure and ecosystem is more suitable for our next new phase of growth and more relevant for the region.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Final trade time. Courtney, you're up first. What do you have for us?
API, think Clubhouse and China Cloud Play.
Okay. Kevin O'Leary?
Facebook, any pullback has rewarded you in the past. It's still the #1 platform for digital spend for small business and job creation in America.
Okay, good day for that stock. NASDAQ's having a great day too. Pete?
Workhorse, Scott. I see some calls being bought. I jumped on those. I bought the calls during the show.
And Mr. Weiss?
Qualcomm and Qorvo are going to blow out the quarter on Wednesday. Still time to get long.
Okay, thank you for that. It's good to see everybody. Shovel safely if you're in this area. A lot of snow is falling. Let's check the markets real quick. I think we're at the highs of the day. Again, a big week for earnings, so much more going on as well. That does it for us. The exchange begins right now.
And indeed it does. And hello, everybody, and happy snowy Monday, at least in the Northeast. Probably 75 in Florida. Who knows? I'm Brian Sullivan. Welcome, everybody. A shiny new bet. Silver shooting higher. Is this the latest play in the Reddit rebellion, or are some being played? The story gets more interesting by the hour. More good news on the vaccination front. Moderna says its vials can hold more doses than currently approved. All this is we're on pace to get 100 million shots into arms by early March. And speaking of good news, could we actually be seeing some real old-fashioned bipartisanship on the Hill? Maybe, or maybe not. And it all comes with a price tag. We'll get to all that and much more over the next 60 minutes or so. We've also got a nice little jump in most stocks anyway to kick off the week. So let's kick it off with our friend Bob Pisani. Bob.
Brian, good to see you as always. We are right at the highs for the day. And once again, this negative correlation with the shorted names continues. As they're down, the broader market is up. There's the S&P 500. We have almost erased all of the big losses we had on Friday. In fact, the Nasdaq's having a fabulous day. It has erased all of the losses that we had on Friday. Dow Industrial is underperforming a little bit. Russell 2000 also, but still everything's on the upside. And the reason we're getting such a nice outperformance from the Nasdaq is mega cap tech is having a terrific day. So right across the board, Microsoft, Apple, Amazon, Alphabet, all up. It was a rocky week, last 5 or 6 days. Apple was 144 at one point 6-7 days ago, went to 130. As you can see, it's bounced back a little here, but we've moved down quite a bit off of the highs here. The shorts, I mentioned that inverse relationship with the shorts that's out there. GameStop got as low as $212. It's up above that right now, but it's a long way from $325 where it closed on Friday. AMC, Bed Bath & Beyond, Express. AMC was way up this morning. It's off of those highs, though still marginally to the upside. But basically, the shorts are down today. Those commodity ETFs. Now, I know we've been concentrating on this interest in silver, but I just want to point out silver is lower than it was earlier in the day. But uranium, you're looking at copper, we're looking at platinum, all moving more than normal today. So I think there's an overall interest in commodities in general today, whether or not that really translates into any kind of serious short squeeze. We'll see if that actually happens. Guys, back to you.
Yeah, what's the short level on uranium? All I know is I don't want to take physical delivery there. Bob, very quickly, though, over the weekend, a lot of us were going back and forth about what exactly was going on with the market. Based on the price action today, the big caps that you just laid out, right, the hedge fund favorites, does it indeed look like those are the ones that got sold to cover the margin calls and any kind of redemption requests from hedge fund clients? And now, you know, Melvin's completely out of GameStop. So this is just the buyback of what had to be sold a few days ago.
Yeah, look what got sold big last week. A mega cap and semiconductors. What were big winners prior to that? Mega cap and semiconductors going in. So there definitely was what we called a degrossing. They lightened up on overall positions, long positions as well as short positions. And today, as we saw, these a little less volatility in these shorted names, market tends to drift upward. And that's because the fundamentals there, the vaccination story, the stimulus story, and the earnings story, which is really turning out to be great, all are what matters ultimately for the market, Brian.
And for humanity, by the way, 12 straight days with more than 1 million shots in arms in the United States. The story doesn't get told enough. We're going to tell it a little bit later on in the show. Bob Pisani, thank you very much.
Thank you.
All right, well, it seems like right now everybody is debating the real impact of retail traders and Reddit users on rising silver prices or the other commodities Bob just showed you. So to get to the bottom of it, we figured we'd do something novel. You know, actually talk to somebody who sells silver, because silver is on the move, close to its biggest one-day gain in a decade. Now, it's not just today. You can see the silver rush began last week after some mentions, yes, on Reddit. But what about physical silver, not just paper moves. Joining us now is Michael Whitmire, CEO and co-founder of JM Bullion. They are an online precious metals dealer. They typically got about $1 million in sales on a Sunday, but Michael, from what I understand, and correct my numbers if I'm wrong, you guys did $27 million over the weekend?
Yeah, just over $27 million on Sunday alone. Substantial numbers for us, enormous increase in demand that we've been seeing since essentially Wednesday night when those Wall Street Bets posts went up. So we've been scrambling, working hard, trying to keep up with demand.
Yeah, and a little bit later on, we're going to talk about whether or not these are real, quote, retail traders, or is a lot of conspiracy. Are these hedge funds in disguise?
Yeah.
Based on the order size that you're seeing, Michael, can you determine in your years of experience maybe who these buyers actually are?
Yeah, these are individual investors. We're seeing a lot of activity from our existing customer base who we've developed over the last 9 years. We are seeing substantial increases in new customer activity as well, but it's across the board and it's individual investors. Average purchases for us range between $2,000 and $3,000. We do have customers who purchase 6 figures or larger, but on the whole, this is individuals who are purchasing physical silver for delivery.
Are they buying coins? What exactly are they buying?
Yeah, so it's a mix of coins, bars, and rounds. We typically have about 1,000 silver products in inventory available for purchase. We're getting so cleaned out right now that we're actually, last I checked, down to about 80 items in stock, which is a number I've never seen before and never thought we would ever see.
So you're almost out of silver inventory. So if you want, I'm sure, to sell silver, which means you got to go get more. Can you go? Do your suppliers have more silver?
No, the entire industry is frankly wiped out. So what we're selling now is predominantly future deliveries. So we can secure silver that will be produced and shipped to us in the coming weeks, and we can offer that for sale to our customers so they can lock in today's spot price and take delivery in the future. But in terms of actually finding live silver that you can purchase and receive today, it's becoming impossible.
When do you think we're going to have more supplies? And by the way, without maybe you can't reveal it, Michael. Who is are you buying for the Federal Reserve? I mean, who do you buy from? If you don't mind telling us.
Yeah. So one of the primary suppliers is actually the U.S. Mint. So they produce our most popular silver product, which is a 1 ounce coin called the American Silver Eagle. They have the capacity to make around 500,000 ounces of that product on a weekly basis. For context, since Friday night, we've sold over 260,000 ounces of those, and that would have been substantially higher if we had not run out. So that kind of puts into context, we're just one dealer in one geographic market. That's kind of the shock to the supply chain that we're going to be dealing with for months.
And can you correlate, and I know you're not exactly in tune, Wall Street Bets, Wall Street Silver, which is a new Reddit subreddit created a couple of days ago. Have you been able to poke around? Do you think there's a direct correlation in terms of your order flow and sort of this online attention the last really 3 to 4 days? Direct correlation?
Absolutely. It was like a light flipping on overnight Wednesday, and it just went crazy Thursday, Friday, and over the weekend. So as I mentioned, we did see increased activity from the existing customer base, but I believe that was actually driven by, essentially media attention on this story and, silver being in the headlines as a potential target of Wall Street Bets. So we are seeing those Reddit users coming in directly making purchases, but on the whole, it's actually a lot of our own customers, I think, trying to get ahead of, what they're trying to do.
Wow, so maybe a combination of both. Truly incredible. Some of the lowest inventories you've had. Maybe the mint is out of silver. I don't know. Michael Whitmire, really fascinating on-the-ground stuff. We appreciate it. Have a great day.
Thank you.
All right, so let's peel it back a little bit and get more down the macro markets and what has led to the volatility that we have seen in some of the Reddit rally stocks and how it might overall impact the market. We're joined now on the phone by Bob Dahl, Chief Equity Strategist, Senior Portfolio Manager at Nuveen, more than $1 trillion in assets under management at that firm. Bob, I want to get to equities in a macro way in a moment. Can you believe what he just said? At least one bullion dealer is basically out of silver and not sure he can get more. I mean, you've been doing this a long time, and I say that respectfully. What's your take on everything that's going on right now?
Well, and Brian, it's a surprise to me it hasn't happened before this. I mean, when you think the ingredients of, essentially free money, lots of checks getting mailed, people having time on their hands, commission-free trading, that these mini speculative activities haven't happened before is a bit of a surprise. And, yeah, it's creating volatility in markets. It's making some people squeamish. You know, you hear people saying it's a rigged game, or somebody say I can't compete. You know, it's a wild west at the moment.
Well, it is, and a lot of people, by the way, are getting rich as well. Now, there's some data. Goldman Sachs out over the weekend said that on a macro level, they ran the numbers, and that what they saw on Friday was the biggest short squeeze in 25 years. In other words, it worked, right? Firms had to deleverage. Maybe they had some redemptions. They have to raise cash to sell what they sell. Squeezes, as I understand them, do tend to be good for stocks longer term, tends to get some of the froth out of the market. What's your take on equities going forward and what we saw on Friday?
Look, I think that the noise around these squeezes, the presence of them, has to let up somewhat to get, the average investor back to, oh, yeah, I need to focus on the economy and earnings, and that's what moves stocks. Isn't that the case? So we have some headwinds to get through here, Brian. As I indicated earlier, I'm not sure this is the last of the speculation we'll see. It does increase volatility in both directions, and we saw it on the downside Friday. We're seeing it on the upside today, and I think the kinds of volumes you are seeing in some of these securities that have been, can I use the word victimized, is way up there, and that's a result of a lot of players, Brian.
It is, though, and there's this whole narrative going around like, oh, the little guy beating the big guy, and, like that, whatever. By the way, and what the media, CNBC, thinks about it, by the way, I think it's a great thing. I just want to be on the record for that, because as long as many of these people, Bob, don't get their donkeys handed to them, if you know what I mean, then you're getting this renewed interest in the stock market. For a decade, everybody moaned that the retail investor was wiped out after the internet crash, and then again in the great financial crisis. We need people to be interested in the market other than just a few machines and high net worth clients. I mean, overall, do you view this as a positive, or am I just completely wrong?
No, I think you're right on to it. And some of these, I mean, you go back to the decline last year, some of these individual investors, some of those networks, they were buyers near the bottom, and they bought high beta stocks, so they did well coming off that bottom. So, the retail guy doesn't know what he's doing. A lot of them don't, but a lot of them do too well. And that's the beauty of the market. Anybody can play.
There's a guy, and we got to go, Bob. There was a gentleman over the weekend. I saw an interview with him in St. Louis. Makes $45,000 a year. Put, I think, $4,500, which, by the way, that's about 10% of his income. Be careful. Into GameStop and GameStop options. And on paper, as of, I think, Friday night, was worth $1.1 million. Now, maybe he sold, made some money. But by the way, if that's not knowing what you're doing, I'll take that all day long and twice on Sundays. Bob,
don't forget to sell. Don't forget to sell.
You never lose money by taking a little profit, I guess. Even the old adages may work sometime. Happy shoveling, Bob Dahl, because I know what you're going through, my friend. Yeah, thank you. All right, coming up. So, are Reddit users the only driver of this silver boom that we are saying? Well, a deeper dive suggests it may not be that simple. We'll show you why. And some positive news, not only on COVID, but also on the vaccine front. The details of Meg Terrell coming up. And as we begin a new trading month, take a look at two stocks who did not dominate the headlines in January, or really got no love at all. Or maybe you should have. Viacom and Discovery, both up more than 30% this year. Apparently, TV is the new TV. We're back after this.
This is The Exchange on CNBC. The Bond Report is brought to you by PIMCO. Bond Report is brought to you by PIMCO.
I'm Jemima Versace, and these are the stories you should be checking out on CNBC.com. The social media-fueled trading mania has found another target, silver, sending the spot price and mining stocks soaring. Some Reddit users, meanwhile, are urging retail investors to target ETFs backed by silver bars. That story's on the website now. China could surpass the U.S. as the world's largest economy a few years earlier than was expected due to its rapid recovery from the pandemic. The latest GDP figures show if the yuan strengthens a little bit further, the catch-up could happen as early as 2026. Head online for the full story. And Ryanair is forecasting a record full-year net loss of nearly 1 billion euros, adding it is impossible to give guidance for 2022. The low-cost airline warned the pandemic was wreaking havoc on its business after third-quarter revenue fell by 82%. Check out that and more on CNBC.com.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
The initial conservative is going to take around 15 months for Indonesia, but the president really asking us to accelerate within 12 months. This is really a daunting task for everybody. I think we are very optimistic. We acquired the access of vaccine at the very initial stage, and we negotiate continuously. And we also have to educate people at the same time. In the meantime, we continue asking people to be very disciplined on the protocol.
Welcome back to The Exchange, everybody. Thank you very much for joining us. Dow Industrials having a little bit of a rally on this Monday, not necessarily gaining back what we lost on Friday, but we are still up 252, just off our highs of the session. The high, if you're counting at home, and why not? What else is there to do? Up 277 points, just under 1%. But look at technology. Bob Pisani pointed it out. Maybe it is that squeeze effect that we showed you last week, that the big name stocks that got sold to meet redemption requirements, well, they're all being bought back now in force. So NASDAQ up more than 2%. All 11 sectors are in the green. Technology, communication services are some of your leader. All right. Now to the three big money individual stock movers of the day. Number one is International Flavors and Fragrances. Investors there are sniffing out a win. Shares are higher. A producer of, you guessed it, Flavors and Fragrances, completing its $7.3 billion deal with DuPont's nutrition and biosciences business. 2 days stock up, look at that, just under 15%. Stonks. All right, stock number two, maybe the stock of the day outside of IFF, is Ford. Shares there soaring, well, for Ford, on news of a 6-year deal with Google for in-car connectivity and cloud services. Google, by the way, Alphabet, as you know, also higher by more than 3%. And stock number three, another car, Tesla. Piper Sandler raising its price target on the stock to a new street high of $1,200 from $515. Now, they were about $300 behind where the price of Tesla was, so they had to do something, but they jacked it up to $1,200. The firm expecting new levers of growth for Tesla for decades and decades to come. Well, speaking of electric cars, if you missed the rally in Tesla over the last couple of years, Morgan Stanley says, don't worry. There are 3 other EV names out there that could be ready for big rallies. Morgan Stanley predicts double-digit gains for China's electric car stocks, given strong growth and the rapidly evolving technology. Their picks include, are you ready? NIO, XPeng, and Li Auto. You can read more about the methodology and the names at cnbc.com/pro. All right, on deck here on The Exchange, if you can't beat them, join them. Why hedge funds may be jumping on the back of the retail trader to try to score a profit. And don't forget, you can watch us live on the go using the CNBC app. The Exchange. We'll be right back.
If you can keep your head when all about you are losing theirs, if you can meet with triumph
and disaster and treat those two imposters just the same. The world is yours to trade and invest. See it, IG it.
Quintanilla, John Fort, Squawk Alley on CNBC.
All right, welcome back. Well, if you need some good news in the fight against COVID and the rush of vaccines, and who doesn't, you're in the right place, because the tireless and peerless Meg Terrell has learned that Moderna says it can fit more medicine in each vial and is asking the FDA to try to approve the move, which Meg Terrell, I'm assuming, would help us speed up the rollout even more, correct?
That's exactly right, Brian. So I've heard that the idea here is to alleviate a bottleneck in the manufacturing of COVID-19 vaccines, which is actually in the capacity to do what's known as fill finish, actually taking the bulk vaccine and putting it into vials. So what I've learned is that Moderna has asked the FDA to authorize it to put 15 doses in each vial, up from 10. Essentially, there's not a shortage of the vials. It's that there are a finite number of companies that have these super sterile manufacturing facilities that can do what's known as fill finish. And so the hope would be this could speed up supply by about 50% if you're getting more doses of existing vaccine into vials, Brian. So we haven't heard from the FDA yet on this. We will have to see how quickly they can do this. But if so, it could alleviate one of the bottlenecks that is holding back vaccines, Brian.
Yeah, and just a quick follow on that, because you know when you see the vial, I mean, as I have, I mean, it's minuscule. It's like literally the size of a quarter. But you've got to administer it quickly because we know that it goes bad over a couple of hours. I guess one issue is, can they use all those? Would nurses and other people that are, you know, going to deliver the shots be able to deliver them that quickly?
It's an important question, and we know that the fact that there are 10 doses per vial and the vials are so delicate, you know, you have to use them all at once. This could create more logistical complications. Another thing about this is this vaccine doesn't have preservative in it. So presumably the company would have had to show data that, you know, you can get 15 doses out of one vial without a preservative and still have it meet those, you know, incredibly sterile requirements that the FDA has. But, you know, if we can get more vaccine out, that would be the goal.
Yeah, and, you know, on the case front here, listen, just under 100, that's still way too many. Any's too many. Cases are still elevated, but they have come dramatically down from their highs. I looked at Texas this morning, Meg. A month ago, Texas had 27,000 cases. Yesterday, 9,900. We are seeing that trend, maybe not to that level in other parts of the country.
Absolutely. I mean, we were just showing that wall with cases coming down 40% from their peak in early to mid-January. That's great news. Hospitalizations are also down. We've got about 95,000 people in the hospital. That is still a tremendous number of COVID patients in the hospital, but it is down about 20% from its peak. In terms of deaths, that's a lagging indicator, and that should come down as well, too, but we're still 3,300 deaths being counted every day in the country. Now, whereas these are very good, signals that trends are coming down, public health experts are really worried about these variants. B117, the one first identified in the UK, has now been identified in 32 states, more than 400 cases. We have very few cases of the B1351 variant. One was just identified over the weekend in Maryland, in addition to those two in South Carolina, and one of P1 in Minnesota. Those ones are the more concerning ones, Brian, because of their ability to evade our vaccines and potentially our drugs as well. So even though things are getting better, public health experts say we got to double down to make sure these variants don't take over.
Do we know for sure the vaccines don't work on the variants? I guess that's the confusion, right?
Well, we haven't seen clinical trial data on the Pfizer and Moderna vaccines, but of course the J&J results and the Novavax results gave us a lens into how well those vaccines work on B1351 in South Africa, which you can extrapolate to the other vaccines because they all work on the original spike protein of the coronavirus, Brian.
All right. So, and also good to see South African cases coming down in the UK as well, but they've been also under strict lockdown. Meg Terrell, tireless and peerless. As always, Meg, thank you.